Welcome to the annual Swedish House of Finance conference, Money Market in a New Era of Central Bank Policies. Over the last decade, central bank balance sheet increased by tenfold at a global level. This move broke with decades of tradition of low footprint monetary policy practice and requires academics and market participants to update their conceptual framework of how monetary policy works and affect the economy. Now, this conference aims at bringing together leading academics and practitioners with expertise on this development to answer broad questions such as what is the future of money market, or what are the consequences of central bank acting as lenders of last resort. Now, without further delay, first guest speaker today is Darrell Duffy, who will present how much central bank money does it now take to run the financial system. Now, Darrell does not any introduction, especially to this audience. Darrell is simply one of the most knowledgeable academics when it comes to the microstructure and plumbing of the financial system, and I really look forward to his address. At the end of this talk, we will have 10 minutes of question and answers. You are welcome to write any question you might have in the Zoom chat. Or raise your hand during the Q&A and I will unmute you on Zoom so that you might directly ask your question. Darrell, the floor is yours.
Adrian, thanks so much. It's a real pleasure to be here. I'm really grateful to you and to Quentin and to Magnus for inviting me, and to the Swedish House of Finance for throwing this really wonderful party about central banking and money markets. When I look at the panelists that you've arranged, I can see them in the tableau in front of me. It feels like I'm Daniel thrown into the lion's den. We have all the leading people in money markets, funding markets, repo markets, many of whom I've learned from, and actually many of whom have already commented on this work, with Adam Copeland and David Eland Yang here at Stanford University. So what I want to do is to motivate the topic of the paper, which is that it takes a lot more money, pardon me, central bank money to run the financial system than it used to. And we're going to see evidence of that from US funding markets focusing on repo markets. This is, I've reoriented the talk a little bit towards making it more of a keynote on the topic area of your conference, rather than focusing so much on the specific case of US repo markets. So it's more about the fact that central bank deposits are much more in demand now than they used to be, largely because of regulatory changes. So I'm going to just jump in. I'm going to do a screen share and motivate this. I'm going to leave enough time for discussion. We have an amazing panel. So, whoops. There we go. So there should be time for discussion. I also need to emphasize that, as usual, the views expressed here do not reflect those necessarily of the Federal Reserve Bank of New York or the Federal Reserve System. I need to say that because we're using confidential data from the Fed. So, how much central bank money does it take to run the financial system? Well, it takes more than the level to which the Fed brought its central bank money down in September 2019. This is what you're seeing on this chart is the Fed's balance sheet normalization program, which started around the end of 2017. The Fed had already announced that it would start to reduce the amount of reserves that are deposited at the Fed by US banks. And I want you to focus in this figure showing US reserve balances during our sample period on the three segments of total reserve balances. The blue segment at the bottom are the reserve balances of the 10 largest bank holding companies that are active in repo markets. We're focusing on repo markets because that's the largest funding market for which central bank deposits are used to provide liquidity. The red segment just above it are the balances of the next 90 largest banks. And the green segment above that is everything else. There are thousands of banks in the US financial system. We're not even going to use the data in the green. We're focusing on the blue and the red. But of course, the Fed determines the total and then banks split it up among themselves. As you can see, the Fed's balance sheet normalization reversed in September 2019, going back up again. And that was because there was a big problem in mid-September 2019 when it became apparent that there was not enough reserves to run the US financial system in a way that I'll describe in more detail. And then when COVID hit, of course, the reserves went up and kept going up because the Fed bought an enormous amount of assets in order to deal with the COVID pandemic. And that was only initially for a few days because of an inadequacy of reserve balances. After the first few days of the Fed's purchases, all of the rest was unnecessary as far as having enough reserves. It was a matter of improving market functionality and then eventually quantitative easing. And as a byproduct, it created a lot more reserves than were necessary to run the financial system. And we'll see the implications of that. There were no more problems after that with funding markets and intraday liquidity because there were just tons of reserve balances. And at the end of this talk, one of the options we'll discuss is, well, why not do that all the time? Why not have tons and tons of reserve balances? Well, there are other alternatives, such as the Fed standing repo facility that are alternatives. And we're going to discuss the costs and benefits of those. So what's the evidence? How do we know there wasn't enough balances in the system during the balance sheet normalization period, particularly in September 2019, when this big spike occurred here? Well, we know it because if you look at the vertical axis on this chart, it measures the spread between overnight Treasury-backed repurchase agreements and the interest rate that the Fed offered on balances. Now, as an investment, those are equivalent. They're both risk-free overnight investments. So in perfectly functioning markets, that spread should be zero. Now, of course, nothing is perfect, and we expect little wiggles around zero because arbitrage is not perfect. But you can see there are occasionally spikes in that difference. And if you have really good eyesight or you wait for the regressions, you can see there's also a general secular movement in that spread higher as reserve balances went lower. And the Fed was actually aiming to make this part of the response work. It really wanted to create a little bit of tension and have a shadow price basically for sufficiency of reserves as part of its monetary policy and reserve balance sheet normalization. But I'm claiming it had not intended to cause these big spikes. By the way, we truncated these spikes at 200 basis points so that you could see all the spikes. But this particular spike went to over 300 basis points in the general repo market, which is indexed by SOFR, the Secured Overnight Financing Rate. And it went to over 800 basis points in the interdealer repo market. So it was a very severe spike, and it was headlined in all the financial press, and it caused the Fed some degree of stress. The Fed responded very quickly. Repo rates came back down, but as I'll mention a little bit later, they didn't come down enough. Pardon me, they came down too much in the sense that there was another spike when the COVID hit. Once COVID hit, as I mentioned, the reserve balances were increased dramatically and there were no more issues. Let me go into that in a little bit more detail. Here's the big spike in September 2019. In red is this same spread between the secured overnight financing rate and the deposit rate on reserves. And in blue, you can see the balances of these 10 largest repo active dealer banks. And you can see that despite the fact that the Fed actually did increase balances after the September 2019 spike, the balances of the largest repo active dealer banks did not actually increase that much. They were relatively similar at the beginning of March 2020 as they were at the beginning of September 2019. So my own personal view is the Fed, rather than simply watching the total amount of reserves in the system, probably would have done better to watch the amount of reserves that were available to, or at least used by, the 10 largest repo active dealer banks, because they're intermediating the repo market. You can see, if you look carefully, the spikes that occurred in March 2020 when the COVID pandemic hit. The Fed was able to cure that problem of market misfunction simply by adding reserves. And after it did, and the reserve balances of the largest dealers, as you can see, went way up, the spread between repo and interest on excess reserves basically disappeared and stayed as tame as a pussycat, and remains very, very tame to this point. So this is our window into the fact that it does take a lot of reserves to run the financial system these days, because when reserves get as low as about 1.4 trillion or so, these distortions in overnight repo markets start to happen. Now, sometimes I've gotten comments saying, why do we care? Well, we care a lot in terms of monetary policy transmission. We want that transmission to be relatively steady and predictable, and to integrate into money markets well. We also care about the secured overnight financing rate. It's the new main benchmark for US money markets. And we also care about the other criteria that guide how much reserves is enough. And the other criteria include the speed with which banks are paying each other inside each day, intraday payments. And I'll show you in a few moments the impact of not having enough balances on intraday payments. And there's evidence, lots of evidence I will show you, that when you get reserves down towards these lower levels, intraday payment liquidity goes down. Before I get too much further, let me just summarize our main findings in case we run out of time. And by the way, Adrien, how much more time should I plan to use?
So you have 32 more minutes.
Okay, terrific. I'm going to try to finish a little bit earlier because I'm actually more interested in what your panelists have to say than what I have to say, or I already know what I want to say. So the first conclusion that we reached is that funding market liquidity depends on a lot on the ampleness of reserve balances. You saw that in those repo charts. This was already apparent in a previous paper by Correa, Du, and Liao at the Federal Reserve Board. But we're buttressing the fact that funding market liquidity, meaning reserve and foreign exchange in their case, market liquidity depends a lot on having enough reserves. We're focusing on the reserve balances of the 10 largest repo active dealer banks. It's their reserve balances that we find are most critical for determining whether funding markets are liquid and there is sufficient balances to run the intraday payment system. But the balances of the other banks also matter a lot. And why is that? Well, when the other banks have low opening balances, they pay the largest repo banks late. And that in turn leads to repo rate distortions. In fact, if you had to pick one explanatory variable for disruption in repo markets, it's the lateness with which these other banks are paying the large active repo banks. Let me repeat that, it's critical. If you had to pick one indicator signaling when you're expecting to have funding stress on a given day, it's the lateness with which other banks are paying the largest repo active dealer banks. And why would that be? Well, I see Wen Hao is here today. I'm going to pick on him. If Wen Hao is running the repo desk at JP Morgan, he's going to get a call from his global treasury desk saying, be a little bit cautious about lending our money today because it looks like we're going to be receiving our balances from the other banks later than normal, and we sure don't want to run low on our balances. So yeah, make markets in repos, but be sure you get well compensated and don't lend too much because it looks like we may have low balances today. That's basically the story of this paper. Now, there's some interesting side stories, actually very interesting side stories. One of which is, when do we expect JP Morgan to run lower on balances during the day? Well, when they have to pay for a lot of treasuries they just bought in an auction. And indeed, on auction settlement days, which are a day or two after the auction, these banks have to pay tens, often over $100 billion to the Treasury Department. And those balances get extinguished from the system. They are removed from the reserves system. They go into the Treasury's general account. Now that's critical simply because balances are now lower, putting more stress on the system. It's also critical because the Treasury Department requires that it be paid first thing in the morning. And so when Wen Hao has to pay out all of that money first thing in the morning out of his reserve balances accounts, that means he has less flexibility to manage his intraday payment timing and less balances overall to begin with. And on top of all of that, these treasury securities that Wen Hao's firm just bought have to be financed. So that can put additional stress on repo markets because on the demand side, there's now more demand for funding as these very liquid notes circulate heavily in the repo markets. Less time I'm going to have to spend on the other key determinants, but I will bring them up. There's an issue of quarter end capital requirements. That's the one point in our discussion where it's not intraday balance liquidity that counts in terms of having enough balances to meet your requirements. It's the fact that when you provide more funding, you're using up more balance sheet space. And on quarter ends, foreign banks are affected by that. And that means that they pull out of the market. All of the load now must be borne by the large US dealer banks, or most of the load. And now they have more funding demands on them at the end of a quarter. And that also elevates rates quite a bit, actually, between 10 and 15 basis points. And then also Treasury bill supply matters a lot. And I won't have time to get into that, but maybe we can cover it in discussion. So what did Jamie Dimon say? This is a very important anecdote. It's only anecdotal, but I think it's very revealing. So after that September 2019 blow up in repo markets, JP Morgan had an earnings call for its third quarter, and one of the smarter analysts from Evercore asked Jamie Dimon, who was on the call, "Hey, Jamie, why didn't you invest those reserve balances that you had into the repo market? There were the giant spikes that gave you a lot of profit had you arbitraged those high rates, and yet your balances just sat in your account." And this is different, the analyst asked Jamie, from what JP Morgan did the previous year when spikes occurred. JP Morgan actually did use its balances to arbitrage those spikes. So what was different in 2019? And Jamie Dimon responded, as you can see in the quote at the bottom of the screen, by saying, "We have a checking account at the Fed." And here he's referring to the deposit account of JP Morgan at the Fed, with a certain amount of cash in it. Last year, 2018, we had more cash than we needed for regulatory requirements. So when repo rates went up, that was 2018, we went from the checking account, which was paying IOER, into repo. Obviously makes sense. You make more money. So that's the arbitrage. But now, says Jamie Dimon, the cash in the account, which is still huge, it's 120 billion in the morning and goes down to 60 billion during the course of the day and back to 120 billion at the end of the day. That cash, we believe, is required under resolution and recovery and liquidity stress testing. So I'm going to unpack these regulatory requirements in a moment, but basically Jamie Dimon is saying it's not so much a question of how much we have in the account in total, it's how much we have in excess of what we think we may need to meet regulatory liquidity requirements. And these are intraday liquidity requirements. It's not LCR, which is a 30-day requirement, or NSFR, which is a longer maturity requirement. This is intraday liquidity. So what are these regulatory requirements that prevented JP Morgan from using its huge stock of balances to invest in the repo market when there were apparent arbitrage opportunities? Well, here are the three main categories of regulatory requirements that impinge on intraday, that is in the middle of a day, liquidity that's required of the largest banks. The first one is called CELAR, and that's the sister test to CCAR, if you know what the regulatory capital requirement test is. And in 2019, the large institutions supervisory team was focusing heavily on the ability of banks to pass these intraday liquidity tests. Second is a Federal Reserve Board regulation called Reg YY. And if you read the details in that reg, you'll see that it does cover in detail the need for largest banks to meet intraday liquidity exposures in all foreseeable or plausible scenarios. And then finally, the third item, which has to do with the Dodd-Frank Act requirement that banks are able to be resolved if they run into trouble. And in those resolution requirements, the banks are required to show that if they have to become administratively resolved through a restructuring of their liabilities run by the government, in other words, they go through a failure, in the course of that failure, they need to have enough liquidity, intraday balances, to meet all foreseeable requirements. And you can see that those requirements include things like daily contractual mismatches between inflows and outflows, and daily flows and the movement of cash and collateral for all requirements, including the effect of stress liquidity flows associated with trapped liquidity, and so on. So all three of these buckets of regulation were affecting JP Morgan and all the other large banks in terms of how much balances they felt they should have, not only in the sense of the letter of the rules, but also in the sense that they didn't want to upset their supervisory regulators from the Fed. They didn't want those supervisors coming by and saying, gosh, you were running pretty close to the line there, or you even went over the line. And they also did not want any publicity or loss of reputation for having triggered any fault lines on any of these test requirements. So basically, they became extremely conservative. Now, this takes us to a somewhat different policy issue, which Charles Goodhart, formerly of the Bank of England, once described as the last taxi at the taxi stand rule. And just for those of you that remember Charles' famous metaphor, the passenger comes out of the railway station, goes to the taxi stand to get a ride home, and there's only one taxi at the taxi stand. The taxi driver tells the passenger, I'm sorry, I can't take you because the rule is we always have to have at least one taxi left at the stand. We're not allowed to use it in case somebody comes along. And the passenger says, well, I have come along, I need a ride. And the taxi driver says, well, never mind, there is a rule. We're not allowed to run the available taxis down to zero. And you can see where the metaphor applies here. These banks, even on a very stressful day in September 2019, were making sure that they had plenty of reserves left on their own balance sheets and were prevented thereby from using those balances to meet the needs of market participants who wanted more liquidity. And so repo rates soared. This slide is merely meant to indicate that the volumes in the Treasury market, whether on a stress day or otherwise, are generally very high early in the morning. So most of the action that sets rates happens early in the morning, and that means that the tone of the market, including rates, is set first thing in the morning, which means that when, let's say, Wen Hao on the repo trading desk gets news that he should be very conservative with his balances today, that means that even though the market is not that active later in the day, it's later in the day that the bank has to predict whether its balances will go down a lot or not. So if you're conservative, then you're going to be extra tight on liquidity early in the morning because you don't know whether later in the day that you're going to regret having used up those balances. And indeed, this chart will explain the impact of that on repo rate spreads. And I'm going to take extra time to unpack this chart. On the horizontal axis is the repo market spread, not the spread that I showed you earlier, which is the average across the day for the whole market called SOFR, but rather because we are able to get intraday repo transaction data from Tradition, one of the large brokers, we can look at the spread first thing in the morning in the first 20 minutes, which is plotted along the horizontal axis. So this is the repo rate early in the day when the market tone and the basic rates for the day are actually being effectively set. And you can see that I plotted it here on a log scale so that you can visualize better the giant spikes that are occurring over on the right-hand side up towards 256 basis points. And what is the key variable that is related to that repo rate spread? That's on the vertical axis. It's measured in minutes, and these are minutes later than normal at which the largest 10 active dealer banks are getting paid half of their incoming balances that day. So for example, if the 10 largest repo active dealer banks are getting incoming of $2 trillion that day, which is, by the way, not an unusual amount, 100 minutes late means that they got 1 trillion of that, half of it, 100 minutes later than they normally would, which is normalized to 0. And once that 100-minute sort of excess appears, you start to get these spikes in repo rates up here. This is the big spike that I mentioned earlier. Most of these spikes are over here. So that kind of tells you, if you really want to know whether it's going to be a stressful day and you're predicting early in the morning whether you should charge a high repo rate or not, Wen Hao is going to be getting instruction either based on his own sources or from his global treasuries office saying, we're expecting our incoming payments to be late today, so don't give up money cheap. If you're going to give up any money, make sure that you're getting well compensated. Why are the other banks paying late? Here are the other bank balances on the horizontal axis in billions of dollars. And here is that same variable describing how much later they're paying the large 10 repo active dealer banks. You can see a very tight relationship here. The scatter plot shows that when other bank balances get down below $1 trillion, you're going to see much later than normal incoming payments to the 10 large active dealer banks. The R squared for this relationship is 0.69. And this dot here is September the 17th, 2019. This is when the repo market really blew up. By the way, this dot here, which is equally high, is March 17th, 2020, on the big hit in the COVID market. Actually, the narrative of what happened in the COVID crunch in the repo market seems to emphasize that there was just basically a loss of market functionality, and that had markets been functioning well, you wouldn't have had this problem. That may be partly right, but our numbers seem to indicate that there just wasn't enough balances in the system, which is a much easier problem to cure. So now let's get to briefly into the some more traditional kind of regression analysis. I'm going to start with the variable that I mentioned first, which is the dealer opening balances. These are the total amount of reserve balances of the 10 large repo active dealer banks. And you can see that as those balances go down, the spread between SOFR and IOR goes up, and it's a very statistically significant relationship. I'm going to mention also that quarter end matters, because at quarter end, as I pointed out earlier, the foreign banks pull out of the repo market by and large. That means there's extra stress on liquidity provision for US banks. And you get about a 14 basis point elevation just from that fixed effect. That's not the main story of our paper, because we're not mainly interested in the impact of regulatory capital requirements. But if you want to get a good explanation of the data, you should be correcting for that quarter end effect. And here is the most powerful variable, as I mentioned earlier. It's the effect of changing the median time at which the 10 large active repo banks are receiving half of their incoming balances. And that has that creates an R squared, once you correct for quarter end effects, of 36%, which is quite important. Now, I won't have time to show you every column in the data, but I want to focus on the 7th regression specification, and in particular go to the last row, coupon issuance. So this is the amount of coupon treasuries issued by the Treasury Department on that day. And you can see that this has a very big effect on the spread between SOFR and IOR for the several reasons that I mentioned earlier. And let me just repeat them. First, when the Treasury gets paid, the money comes out of reserves. So the whole amount of reserves go down. So when you have a lot of Treasury issuance, which can easily be over $100 billion on a given day, that brings reserve balances down, and we know what that does. Second, as I mentioned, the Treasury Department demands to be paid first thing in the morning. So that not only removes reserve balances, it also removes the flexibility of when to pay, which other payment commitments generally have. So that lost American option on when to pay those balances is impinging on the dealers, and they're going to be more conservative when they know it's a Treasury issuance, because their balances are low from the very beginning of the day. Some of these other effects are pretty important, like bill issuance and some of these other variables. But as I said, I'm going to come back to that if we have time in the Q&A. The main story, I think you've already gotten, but I want to focus on the spikes in the last few minutes and then finish with a description of some of the alternative policy approaches that a central bank like the Fed can take in this situation. So what about these spikes? So far, I've been emphasizing in regression relationships, the average roll. And by the way, the average roll also is even stronger if you take out the spikes from the data, which we tried. But when you leave the spikes in, effect, although noisier, is bigger in magnitude. If you just focus on the incidence of spikes, we used a Probit model to understand which variables are causing the spikes. And we defined a spike. It's a complicated recipe, but basically it's whenever any of the key repo indices are at least 30 basis points above normal. You can read the fine print in the paper. Okay, so let's start by focusing on the 4 key variables that we believe are affecting those spikes. The median time of receives, which I've already motivated, the opening balances of the 10 large dealers, coupon issuance of Treasury securities, and the quarter end effect. And let's first start by turning all of these variables to normal. So no quarter end, Coupon issuance is at the average level of $10 billion. Opening balances are at the average level during our sample period of 686 billion. And it's a normal day in terms of when the large banks are getting paid their incoming payments. That's associated with a predicted likelihood of a spike of about 1%. So what I'm going to do now is toggle on and toggle off some of these key explanatory variables. The first thing I'm going to toggle is the time at which the largest banks get paid half of their incoming payments. A 1 standard deviation change is 58 minutes. When you toggle that to a late incoming payment day, the probability of a spike doubles to about 2%. The next thing I'm going to do is toggle in a lower opening balances for the 10 largest repo active banks. And that doubles again the likelihood of a spike to about 4%. The next thing I can do is turn off the opening balance effect and return opening balances to normal. Turn off the median receive time, so it's a normal incoming payment day, but turn on the treasury issuance and increase treasury issuance by 1 standard deviation in our sample period to $91 billion. In that case, you again get about a 4% likelihood of a spike. Now I'm going to turn on all 3 of these. It's a late incoming payments day, that's bad news. It's a low initial balances day, that's bad news. And the Treasury is issuing 1 standard deviation more than normal of Treasury securities. Now the likelihood of a spike is estimated at 11%. If we turn on the quarter end effects, and that means the foreign banks are not providing liquidity to funding markets anymore, these probabilities of a spike go way up. So the last slide before our discussion, what should the Fed do in light of what it's learned about the high amount of reserve balances that seem to be necessary to run the financial system in light of the need for banks to make payments in a timely manner and in light of funding market liquidity, meaning the central bank certainly wants the largest repo active dealer banks to provide repo markets that are reasonably liquid, where the interest rate reflects something like the true value of overnight money, rather than some sort, well, it did represent, the spikes did represent the true value of money, but there was this big shadow price in there for meeting intraday liquidity requirements. So what should the Fed do? And as I said, these are rather consequential decisions. This is not about plumbing. It's really about the financial stability, meaning you don't want balances so low that everybody hoards cash, waiting for everybody else to pay them, causing a self-fulfilling expectation of a liquidity crunch. In fact, one of our co-authors, David Elin Yang, is writing his job market paper on exactly that. And Adrien Quentin have another paper on exactly that issue. And you want liquid markets in part because when the Fed raises or lowers rates, it wants market rates to reflect the Fed's desired target level for rates and not some random spike that incorporates the disruption associated with insufficient balances. Okay, so what are the options? One is, well, do what the Fed eventually did anyway because of the COVID pandemic, just have an obviously clearly abundant amount of reserve balances. I think the Fed had always intended that there should be an ample level of reserve balances, but it just wasn't easy to guess. And rather than leaving it to guesswork, just flood the market with reserves. Well, I see Bill Nelson is here today. He's pointed out in one of his papers that impinges on bank capital requirements. There's a thing called the supplementary leverage ratio rule, which means that when the Fed is generating enormous amounts of reserves for banks to hold, that's stuffing the banks with assets. And even though reserves are completely free of any risk, by definition, the central bank determines what a dollar is. there's no risk in central bank deposits in the United States. Nevertheless, their capital requirements are requiring banks to increase equity when they have more reserves. And that, because of debt overhang effects, the banks don't really want to do. And so you get crowding out effect. Another possibility, if you increase balances enough, is that actually Bill has written about this one as well, as have others. If rates were to lift off zero, which may happen someday, the way things are going, then the Fed is going to end up paying the largest banks a lot of interest on those huge balances. And right now, the amount of reserves in the system is approaching 4 trillion, or it's around maybe a bit more than $4 trillion now. If you multiply $4 trillion by 1% or 2% of interest rate, and it could go higher, that's a substantial amount of money. Now, that's not necessarily economically damaging, but it doesn't have a great look for the Fed to be paying the largest banks huge amounts of interest payments, and it could cause some consternation in the news.
Hey, Daryl, I'm sorry to interrupt. So if you want to have some Q&A time, I think we are like about 6 minutes left.
Okay, then I'm just going to stop, but let me just mention the other opportunities: standing repo facility, which the Fed has already done. Relax these liquidity rules so that you get rid of the Charles Goodhart problem and you're able to use the liquidity when you need it. And then another point that Bill Nelson has mentioned, which is to try to get the banks to use the discount window or to draw on daylight overdrafts, which the banks are reluctant to do because of the stigma effect. So I didn't realize I was running so late. I'm sorry about that, Adrien.
No worries. Thanks a lot for your presentation. So we can take a few questions. You can either write them on the chat or raise your hand. I think Per Stromwick has a first question where he's wondering if there's any evidence of broader effects beyond interbank markets of this rate spike on other part of the financial system. And then Marco Machiavelli is wondering whether the small effect of bill issuance relative to the coupon issuance is due to the fact that dealers take more time to offload longer dated bonds and so need to finance them in the repo market to a greater extent.
Okay, so let me address the first one first. There's a lot packed into those two questions. So broader effects. Well, one effect is transparency. So back in September 2019, I don't think people had actually sorted out what was causing these huge spikes in repo markets, and people were very concerned that maybe the financial system was unraveling and that something very, very bad was happening. And really, it was just that there wasn't enough reserves. Had there been enough reserves, you would have seen that repo markets would have been tamed, but market participants had a hard time figuring that out. So market transparency is impaired when you get a lot of noise. Financial stability can be impaired because, as David Elin Yang shows in his job market paper, if this gets bad enough, then everybody's going to hold up paying anybody until they get paid, which is a self-fulfilling crunch. And that obviously has very, very broad financial stability implications. And then, as I mentioned, monetary policy transmission, which is a very broad effect, matters a lot. And if your main policy targeting is not working because it's not getting into the largest and most important funding markets in the economy, then that's also a general economic problem because the Fed's monetary policy is a general economic issue. And then Marco's question, the difference between, we think the difference between bill issuance and coupon issuance is the fact that the coupon issuances are heavily refinanced in the repo market, and the bills are generally not heavily circulated in the repo market. And so that's putting extra demands on repo rates. Is the coupon issuance mechanically pushing down reserves? Yes, it's a one-for-one mechanical relationship. Whenever you issue any treasury security for $100 billion, there's a $100 billion automatic reduction in the amount of reserves first thing in the morning. So I don't know if that's sufficient, but let's move on if there's any more time.
Quentin, you want to go on?
Yes, thank you. So we are definitely on the very same page when it comes to explanation of what happens, but there's still something that's very puzzling to me, which is that after September, the Fed increased the reserve supply by something like 200 to 300 billion. And this, for whatever reason, did not end up in the balance sheet of the securities dealer banks. And I'm wondering, so there seems to be a friction there because that's where the results would have been useful. And I'm wondering if you have some potential explanation for that.
Yeah, I do. So there was actually over 500 billion that the Fed added after the September 2019 crunch, but most of it did not, as you pointed out, end up on the balance sheets of the largest 10 repo active dealer banks. They don't actually lose money when these rate spikes occur. They can, to some extent, make money because reserves are scarcer. So that doesn't bother them so much. And at that point, interest rates were very, very low. So the advantage of holding reserves was much lower than it had been. And then finally, there are regulatory capital requirements associated with the SLR. And when reserve balances go way up, it doesn't necessarily mean that the largest banks want to hold them. They didn't really have any choice after March 2020 because the Fed has now purchased over, I think it's around 5 trillion or so of assets. And so those are going to end up with the largest banks no matter what. They don't have a choice.
All right, let me shoot one last question then. So on the what to do, it is still another possibility, which is not do anything. It seems that there was a surprise shock and the question was left open about how much reserve necessary for a smooth plumbing. But now that we've learned about some friction that can be internalized, maybe market participants will adjust their leverage and their friction need, and then maybe the Fed does not need to add more reserve or other facilities, and the market participant will adjust themselves, such as this repo spikes will disappear.
Yeah, that's actually one of the most common suggestions that I've received is just let the banks work it out. And I think that they would eventually get better and better at handling lower levels of reserves, get more active, put up more desks that would trade repo whenever the opportunity arose. But basically, we saw that movie already in the first episode of that movie was called Fed balance sheet normalization. The Fed was doing exactly what you suggested. It was lowering reserves on a very predictable, smooth glide path, and banks were gradually learning over time, and they had plenty of time to do that, how to manage their reserves better and how to enter the market for repos. But we still had a huge disruption in September 2019, and that was only one of many spikes in repo rates. So I think, yeah, the system could manage eventually, but do you really want to incur the financial stability, monetary policy transmission, funding market squeezes, intraday liquidity squeezes, as you teach the market how to do that? And I would say the trade-offs suggest one of the other policy solutions. But the alternative you just mentioned has been emphasized to me by many, including actually one or two people that are here present today. And so I'm respectful of that point of view, but I happen to disagree with it.
Well, thank you very much for your speech. We will now have a 2-minute break and have our second guest speaker, Emmanuel Mounier-Rousseau. Thank you, everyone.
Thank you, Daryl. Great presentation. Can I ask one quick question? It seems that the problem is about intraday sequence of payment. Why doesn't the Treasury Department wait until the market's clear? Because it seems it's just an intraday issue, right? If they wait, then the problems are solved.
Okay, so, well, that's a great question. I actually called the people in the debt management office that are responsible for this, and they didn't want to engage on that particular question. But if I had to introspect based on conversations with others, I would say it's counterparty risk. The Treasury Department is in a position where it can command that they could be paid early in the morning. And if it decides not to do that, then it incurs the small amount of risk that someone won't pay it during the day. And that would not be a good look in terms of the debt management office. Somebody would write a headline saying, the Treasury Department waited till the end of the day, didn't get paid. Now it has to issue more Treasury securities. This is disruptive, et cetera, et cetera. So I think the Treasury just wants to make sure it gets the first chance to dip into the pool of reserves that are available early in the day.
Thank you.
Great question, Wenha. Nice book collection.
All right, excellent. So Now we have our second guest, is Imen Ramouni-Rousseau. Imen is Director General Market Operation at the European Central Bank since January 2020. And before that, Director of Markets at the Banque de France. With a credential as central banker and experience during the COVID crisis, I think there are few people more qualified to talk about money markets at the crossroads. Again, at the end of the talk, we'll have a 10-minute Q&A, and you're welcome to write any question or raise your hand during that period. Imen, the floor is yours.
Thank you. Thank you very much, Adrien. I hope you hear me well. So many thanks for inviting me to this very relevant and timely conference on the future of money markets. I think you couldn't have chosen a better time. And it's also a pleasure to be here in Stockholm and be part of such an exciting program and lineup of speakers. So central banks around the world have been challenged in the last decade by a decreasing natural rate of interest, R star, and also have been facing multiple crises, financial crisis, but also more recently, the pandemic crisis. And in response, central banks had to increase the size of their balance sheets by conducting large-scale asset purchase operations and providing the banking sector with sizable lending operations. They also introduced low-for-long policies on rates, reinforced by forward guidance, and in some cases, they even explored negative territory on rates, like in the case of the ECB, but also Sweden here. In the case of the ECB, the unconventional monetary policy tools, so the quadrant of asset purchases, long-term lending operations, negative rates, and forward guidance, have recently been integrated to the conventional policy toolkit through our strategy review, especially when we operate closer to the effective lower bound. With these actions, central banks have set money markets at multiple crossroads, and I'd like to explore this crossroads with you today. So looking at the euro area and at the implications of the challenges of central banks, there are really three main crossroads I will explore. The first one is on large central bank balance sheets and their implications for money markets. The second one on low for long policies and negative rates and their implications. And the third one about evolving operational frameworks for central banks. So starting first with large central bank balance sheet. The size of the ECB balance sheet pictured here reached a record high of 8 trillion euros in mid-2021. How did we get there? And what are the consequences for money markets? The ECB policy focus, if we go back to the last decade, shifted gradually from steering short-term money market rates, primarily via our repo operations, the MROs, until the great financial crisis in 2007, towards balance sheet expansion through long-term credit operations that importantly extended above 1 year and asset purchases later on. These new balance sheet expanding tools were required both to react to financial crisis and address market disruption, but also to ease the monetary policy stance when our policy rate became close to the effective lower bound. The increase in the size of the balance sheet had actually been put forward as an intermediate objective by former ECB President Mario Draghi in September 14 and was conducted in phases, starting asset purchases first with private sector assets, covered bonds and ABS, and then enlarging it to public sector bonds and finally corporate bonds. And then of course the longer term refinancing operations, the TLTROs also helping with that. As a result, the excess liquidity of the banking sector has grown in tandem with the size of the balance sheet from virtually zero in the old system to over 4 trillion today. So I'll explore the three main impacts of large balance sheets and high excess liquidity on money market dynamics. Let's start with the first effect. So with excess liquidity, there is a change in the composition of transactions on the money markets, with interbank transactions between banks shrinking and transaction with non-banks increasing in proportion. Starting first with the interbank segment here on that chart, the closed system of central banks reserves, which circulate among banks, but at the end of the day, all end up in the balance sheet of the central bank, means that reserves have to be held ultimately by banks. In a situation of high and persistent excess liquidity, banks are reserve rich and on an aggregate level are in over-compliance with their minimum reserve requirements. Therefore, their motivation to trade reserves with other banks in the interbank market diminished greatly. Given their rich liquidity positions, banks don't want to pay up for borrowing reserves, and at the same time, very logically, they don't want to lend below the deposit facility rate, which they can get at the ECB. As a consequence, interbank volumes have diminished, and also a number of other factors have played a role. The great financial crisis has brought a higher counterparty risk. New capital regulation also made interbank unsecured lending more costly. And therefore, we see on the left-hand side that the volume of unsecured interbank transaction goes down. And we see on the right-hand side that the overnight rate, the EONIA, has decreased as excess liquidity increased. And the overnight rate now is in line with the level of the deposit facility rate, so our floor of the corridor, while before it used to be at the middle of our central bank corridor of interest rates. So that's the effect on interbank. But the flip side of this is also that transactions with non-banks have become more important in proportion. And this is illustrated in this chart, where you have the classic monetary policy corridor in the gray lines. So you have the top of the corridor, the marginal lending facility at 25 basis points, positive. You have the rate on the main refinancing operations on the zero line here. And then the bottom of the corridor, the deposit facility, currently at minus 50 basis points. And what is striking here is that all the action, with the exception of the EONIA rate, takes place below the line of the deposit facility rate, which is the dotted line here, So you see all those rates being below the deposit facility rate. And it's a simple explanation. Banks are reserve rich. They are in a position to charge non-banks who do not have access to the deposit facility a spread for accepting deposits to their balance sheet in order to compensate for things like regulatory costs and other costs. This spread for storing liquidity is visible in overnight money rates, but also in other market segments like the repo market, and we'll come back to this. So this new reality of life below the deposit facility rate is also acknowledged by our new benchmark rate, namely the Euro short-term rate, which is a wholesale rate and includes transactions of banks borrowing from non-banks. So this composition also explains why this new reference rate, which has been used since November 2019, hovers below the deposit facility rate as well. Despite this new dynamics, the ECB does maintain control over money market rates, as the spread between the DFR and the overnight rate, the EUR-STR, remains relatively constant. The second effect of excess liquidity and large balance sheets stems from the securities that the ECB purchases and which are therefore no longer available in the private market. In addition, some securities are also pledged as collateral in our pools and are therefore encumbered for the banks. So from this chart, you see clearly that the Eurosystem footprint, if you measure it as a proportion of the total outstanding amount of government bonds, has increased over time, but that the market still functions because the huge blue area that you see here is the holdings of private investors, which are still sizable. But the red lines indicating the footprint of the euro system. So this footprint is today around 35% of total outstanding government bonds. And if you add to it the securities taken as collateral, then you reach 40%. So this increasing footprint has implication for money markets, and in particular for repo markets. Why is so? Because basically you have scarcity effects that start appearing when the footprint increases, unless you put in place a mechanism to put the securities back into the market. And this is actually exactly what we have done with the introduction of the Eurosystem Securities Lending Facility, which is available to our counterparties, and where they can borrow securities back from the ECB at a penalty rate to the private repo market in order to provide an effective backstop to repo rates. This allowed in the past 5 years to support bond and repo market liquidity without curtailing normal private repo market activity. Since March 2020, the Eurosystem purchases accelerated with the launch of the PEP, our emergency program, and with the TLTRO III, our targeted lending operations. And here again, the securities lending facility, you see that on the right-hand side, has played an important role as demand for borrowing securities at the ECB has picked up, and this demand has been met by the functioning of the facility, therefore contributing to dampen the effect on repo rates and on the scarcity of securities. Finally, the third effect is that the sizable take-up of banks in our attractive longer-term refinancing operations, the TLTRO III, enabled also by the easing of the collateral requirements, our collateral easing linked to the pandemics, all of this has significantly eased conditions in money markets. And so you see on the left-hand side the high take-up in these longer-term refinancing operations. And then you see on the right-hand side that the Euribor, the major short-term unsecured bank rate in the euro area, has declined to record lows. So, all of these measures, the TLTROs, the collateral easing, have reduced the need for banks to enter money markets to source liquidity. And given the broad eligibility criteria for collateral, these operations have also indirectly alleviated banks' constraints on liquidity ratios, such as the LCR. So this is on the first crossroad on large balance sheets and excess liquidity. Let's now go to the second one on low for long and negative policy rates. So when the ECB started cutting its deposit facility gradually into negative territory as of June 2014, this was a completely new measure. And only a few central banks had employed it before. So it's interesting to look on the left-hand side here at the way that these cuts below zero have actually transmitted to money market rates. You see the blue bar is always the magnitude of the cut. So we have cut every time by 10 basis points. So it's the same blue bar for all 3 dates selected here. And then the transmission is shown in orange for interbank rates, and then in gray for repo rates. And what you see here is that for the first rate cut, and what we do, again, is that we make a distinction in the transmission between the immediate reaction in solid bars and the delayed reactions in shaded bars. Yeah. And the first time that the deposit facility rate was cut by 10 basis points in June 2014, that's the date you see on the extreme left, you see that the market reaction was stronger than the initial 10 basis points. And this is because the ECB at the same time undertook measures to increase excess liquidity and stop sterilizing some of our asset purchase operations. But with this first cut, into negative territory for the policy rate, market rates actually remained above zero. So what was interesting was to look at the second rate, which is in the middle, in September 14, where actually market rates had to go to negative territory. And this took way more time, than for the other cuts, because you see these dashed bars that are much higher in proportions. But from the moment this was done, and certainly there were frictions in bringing the market rates below zero, but once this was done, all the other sets of cuts, including the most recent one in September 19 that you see on the right, you see that the transmission has actually been a non-event, very smooth, of the same magnitude of the cut to money market rates. So markets have adapted really well to the new environment of negative rates. And on the right, you see what the policy did to the money market curve. And we see that short-term rates declined, but also expectations of future short-term rates have kept shifting downwards with every cut, bringing significant accommodation, partly also because zero was no longer seen as the effective lower bound for expectations. So coming now to the volumes and the impact of the negative rate environment on money markets volumes. We see here from 2003, money market volumes in total, including unsecured in blue, repo in yellow, and FX swaps in red. And what is clear is that money market activity has remained robust or even increased slightly in size when we introduce negative rates, which is shown here by this bar in June 2014. And so when we take this broader perspective, we don't find a detrimental impact of negative rates or, for that matter, the increase in the balance sheet on the turnover in the money market. But of course, what was ultimately sought with negative rates was the transmission of these negative rates to the lending rates to the real economy. And there it's important to look at the transmission of negative rates to deposits in the banks from the corporates, that's the graph that you have on the left, and the households, that's the one on the right. And clearly, the pass-through to deposits has been lower and more delayed than what has happened on market rates. Banks faced important reputational challenges in introducing negative rates to their depositors. Negative rates have first been introduced to large customers, which had already been confronted with negative rates in financial markets. So this, you see these large customers again in the left panel. And regarding retail depositors and households, banks were very reluctant to transmit these rates. And they first started by imposing higher fees to these depositors. This is not captured in this measure, but from anecdotal evidence. And then with delayed reaction, they started to then pass negative rates, but clearly for households, this is still very limited. But it's there, and it's actually increasing over time. So here again, the bank policies are also adapting to the negative rate environment. So now coming to the third crossroad that I wanted to highlight, that's the one related to evolving operational frameworks of central banks in the longer term. And I think this is only just starting, but this is going to really dominate the debate, in my view, in the next 2 to 3 years. And these operational frameworks will need to evolve for many reasons. One of them is very simple. It's the fact that central banks are approaching their next normalization cycle, and the way that they will adapt their framework in the normalization phase is not yet completely defined. But the other reason is that, of course, there are a number of structural factors that are affecting the financial system, one of them being non-banks, and we will come back to that, but also things like central bank digital currencies. So I identified today 3 main questions for our crossroads. Yeah. So the first question is it desirable to maintain a regime of ample reserves? And I think that Darrell's speech before mine was a wonderful, I would say, gold mine of arguments and information about that. The second one is it feasible to operate a regime of scarcer reserves? And then the third one, combining the first two, is what is a desirable and feasible intermediary function towards money markets given the role of non-banks? So we'll go into each of these 3 in turn. Is it desirable to maintain a regime of ample reserves first? So operating a regime with abundant reserves has 2 main benefits, which might be desired. First, this regime would offer the possibility to disentangle the steering of short-term rates from the balance sheet operations. Second, it obviously facilitates the fact that banks hold larger buffer of reserves and are therefore less reliant on money markets, and this dampens the impact of liquidity, those liquidity fluctuations that Darrell talked about on the volatility of money market rates. But there are also important negative effects. Yeah, I mean, it's a system that has less embedded discipline. I mean, we can discuss that, and also perhaps there's a loss of monitoring function for banks in this system, and this can lead to a less optimal situation. Regarding the ECB, we can ask this question, is it desirable? But the reality is that the ECB is expected to operate in a regime of ample reserves for some time to come. So on the chart, you see in blue the recent increase in excess liquidity reaching this 4 trillion that I mentioned before, and then in gray, a range of projections of excess liquidity. And even if the current measures were to expire on their scheduled time, excess liquidity would stay at very high levels for many years. And even at the end of 2028, excess liquidity would still stand at 2 trillion euros. So in this kind of system, the deposit facility rate is expected to remain the anchor as the floor of the corridor. It is really a floor system to remain the anchor for money market rates. So now, aside from the policy preference on reserves, there's also the question of feasibility. And so to what extent is it feasible to operate in a regime with lower levels of reserves? And how much volatility in money market rates is tolerable in such a system? As excess liquidity declines to lower levels, this raises the question of how many reserves the central bank needs to provide as a minimum to keep short-term rates close to the floor. And on the left, this is really empirical data. You see that when in the past excess liquidity reached lower levels, basically below 1 trillion euros, upward pressure on money market rates was observed. Yeah. And rates tended to rise towards the middle of the corridor, so the MRO rate, rather than the deposit facility rate, the floor. At the same time, and I think this is absolutely key, and we saw it with Darrell's speech, and we will continue to discuss it, there is increasing uncertainty on the extent to which banks' demand for reserves has changed over time. And here I just put 4 factors, but there are many others. The first one is the famous payment needs, the access to intraday credit that is very important. The second one is liquidity regulation. And in the euro area, there is, and we know that from the US experience, this impact can be quite, multifaceted. And regarding the euro area and liquidity regulation, there is no strict regulatory requirement in the euro area for banks to hold reserves. Yeah, the requirement is on HQLA, on high quality liquid assets. But banks may have a preference to hold it in the form of reserves for their compliance with the LCR, especially in an environment in which short-term government bond rates trade very close to the deposit facility rate. And so there's no opportunity cost, yeah? A third factor linked to that in the euro area is the heterogeneity in euro area government bond yields, which is also a factor providing an incentive for certain banks in certain jurisdictions of the euro area to hold HQLA in the form of reserves, because this has no credit risk. While if you hold it in government bonds of other countries than your own jurisdiction, you would be facing a credit risk. And finally, banks' business models, they have been adjusted to this environment of, plenty of reserves and liquidity, and therefore practices in liquidity management currently set up, they are really set up to rely on a large buffer of reserves, and they are not set up to address high frequency fluctuations in reserve holdings via the money market. So here in the next slide, I just wanted to illustrate for the euro area the role of intraday credit, which is really important. And I think that in the euro area, the fact that the access to intraday credit is very easy, is only limited by the amount of available collateral. This allows the banks to monetize their collateral very easily into reserves, and therefore this lowers their demand for reserves, their precautionary demand for reserves. On the right-hand side, another factor is that the concentration of reserve holdings in the euro area is somehow less than the US. And this can also contribute to lower the precautionary demand for reserves. So now I come to the last question, and that is, what is a desirable and feasible intermediary function of the central banks towards money markets, especially given the role of non-banks? And I will separate this very clearly into two parts. The first one is looking at liquidity providing operations for non-banks, and then looking at liquidity absorbing operations, so deposits of non-banks, because it's a totally different question. And all of this is very preliminary. It is not yet a central policy question, but of course, given various episodes, and in particular the Dash for Cash episodes of March and April 20, this is a very relevant question for a number of central banks. So it's no secret that the non-bank sector has grown in importance over the past 10 to 15 years. And in the case of the euro area, due to the benchmark reform on the interest rates, on the euro short-term rates, the transactions with non-banks actually flow directly into the operational target, because the euro short-term rate, our new benchmark, has, includes the transaction with non-banks. And so this kind of directly increases the importance of these transactions with non-banks for the transmission of monetary policy. And one can also have the intuition that in times of market stress, these non-banks can be very important for monetary policy transmission. This being said, the ECB has also proven to be very efficient in alleviating market stress, including market stress and liquidity stress related to non-banks, via the traditional banking sector through its banking counterparties. And the episode of March and April 20 is a good example of that. Why is this? Because if you combine all of our instruments that indirectly can address the stress of non-banks, you have the fixed rate full allotment policy, you have the funding support provided via the TLTROs, the collateral easing, and you also have the fact that we have expanded our asset purchases to certain assets which play an important role for non-banks, namely commercial paper for money market funds. And so when you have all of this apparatus, you can actually relieve market stress indirectly via the banking system. But of course, this all depends on dealer capacity to bear risk. So this is why the question of the access of non-banks is still a quite relevant one. And this requires clear thinking on the purpose of providing this liquidity to non-banks. Yeah. Is it to ensure a smooth transmission of monetary policy? Is it to protect financial stability and address market dysfunction? And you see at the right side of this chart that there are several benefits for the non-bank sector access to the central banks. And but still, I mean, you see, ease funding costs for non-banks and so on. But you can still achieve these benefits indirectly through the banks, and the negative effects of allowing non-banks lending to non-banks by the central banks also shouldn't be underestimated. Yeah. So it's you have moral hazard considerations that have to be taken into account because by providing them with a backstop, you would normally take over their liquidity risk management, and therefore this lowers their incentive to conduct prudent liquidity management. But we can discuss a bit about that. And you also have the fact that operationally speaking, it's actually quite difficult to provide non-banks with access because they are so different. Yeah, many types of non-banks, and also they don't have a standard central bank account, so you have to reconfigure a number of things, including your bidding systems, your counterparty framework, and so on and so forth, and also assess financial soundness importantly in an appropriate way. So the other possibility is to deal with non-banks by providing them access to a central bank account. So basically to absorb liquidity, and this is different questions. So in the case of the ECB, the context is that we've seen that with this very high excess liquidity, money market rates have dropped below zero, but also below the deposit facility rate. And so it might be claimed that in the normalization cycle that will come at some point, having money market rates that are closer to the DFR might be desirable. So higher control on these money market rates than today. But what would be the impact then? Yeah, I mean the impact, and you can see that in the charts on the left-hand side here, is that today these transactions with the non-banks dominate really the volumes on the money market. And so if these transactions no longer happen between banks and non-banks, and the non-banks can go directly to deposit at the central bank, it means that the central bank takes over a huge part of intermediation on the money market, and it also cannibalizes the volumes in money market rates and in our benchmark rates, the Euro SDR. And so that's clearly a trade-off between enhancing the control over our money market rates, possibly by providing non-bank access, and the extent to which the negative consequences of increasing intermediation are acceptable. And on that, let me conclude the main messages of my speech today. So first, money market dynamics have changed since the great financial crisis, and also due to the increasing balance sheet of the euro system. Second, money markets remain active and functioning, have proven to be robust to negative interest rates and low for long policies. And finally, the ECB's policies and the outcome of our strategy review that I mentioned at the beginning will be important drivers for euro area money markets in the future. Thank you very much. And I'm happy to take any questions you might have.
Thank you very much, Imen. So now we can take a question from panelists or attendees. Feel free to raise your hand. Quentin, you want to shoot?
Yes. Okay. So I start with a question, then I explain why I asked this question. So the question is again related to intraday liquidity. And so I was wondering, how do you take into account the intraday liquidity needs in terms of determining the amount of reserves that you need in the system in the case of the euro area? And I'm asking this question because I think there is a clear contrast between the current implementation in the euro area and what Darrell has just shown for the Fed. And I see that Zoltan is here in the audience. So I think the main difference that because of this intraday liquidity regulation that Darrell mentioned, the US system is de facto a token system and not a credit system anymore. And that's something that you see from the fact that we don't see any intraday credits, that the banks don't go and borrow intraday from the Fed. So my take is that in this particular case, we shouldn't count intraday credit at all, because the intraday credit is basically free. So the banks can go and get it, but you need to make sure that you remain in this credit system and don't fall into a token system.
Okay. Should I go ahead and answer? So it's a really,
yeah. Go ahead. Sorry.
I mean, it's a very good question. So, I mean, in the case of the euro area, as I mentioned, intraday credit is not only free, it's also very easily accessible, and there are no restrictions other than the amount of eligible collateral that you have pledged at the central bank. And by the way, it's the same pool of collateral for intraday credit and for your monetary policy operations. So, you know, it's also very easy. And what we see is that also there's absolutely no stigma in accessing intraday credit in the euro system for various reasons. One of them is that this is not reported to the supervisor. I mean, it's not considered as a relevant information to report because it's the normal course of business, yeah? And the second thing is that even if this, you know, the number, for example, in aggregate of institutions accessing intraday credit was known, the banking system is so broad and so diverse that the stigma effect is much less. And we see that, for example, in the case of the marginal lending facility, which is our repo facility on an overnight basis. So answering your question, I mean, what we see on intraday credit in the euro area is that it's a very reliable source of liquidity in order to smooth intraday fluctuations. We've looked, I had that in one of the slides. Again, you look at it, that the usage of intraday credit has declined with excess liquidity, of course, but it's still, you know, about 10% of institutions use it very regularly. Yeah, and this is really a non-event. And I think it should be so. Yeah, I mean, it should be so that this is one of the kind of flexibility available to the banking sector in order to accommodate, you know, the intraday payment fluctuations.
Thank you. George, you want to ask your question?
Yes, thanks. Iman, you didn't, this is George Selgin from the Cato Institute. One option that you didn't mention that's in between that of going to a scarce reserve system and keeping the abundant reserve system is a tiered system where you grandfather some large amount of outstanding reserves, but then have the system operate as a corridor at the margin, so to speak, where the interest rate paid on the grandfathered reserves is higher than the interest rate paid on the marginal reserves going forward. Could you say anything about that option by way of completing the discussion of the choices that are available?
Yeah, I think that's a good point, that actually in between the floor system, like the pure floor system and the corridor system, you have a myriad of intermediate solutions. And my personal take, but of course, I mean, we're very, very busy looking at all these options because this, as I mentioned, I think the reform of operational frameworks is going to be a large part of our workload in the months and years to come. My personal take is that you should have a simple system as well. Yeah. And one of the virtue of the floor system that I haven't mentioned actually is that it's very simple. So I take absolutely your point about having, this kind of system which is intermediate. You have part of it that is grandfathered, the rest operates more like a corridor and so on. But how? I mean, we certainly can put it in place as a central bank, but whether counterparties can also adapt efficiently to such a system and learn how to optimize their liquidity management in such a system, maybe I'm a bit less convinced. But I mean, again, this is how it goes into crossing what is desirable, what is feasible, yeah. And coming from a market operations department, I tend to, focus a bit about the feasibility of such a system, but clearly it's in the range of possibilities we would be looking at. So thanks for raising this option.
You're welcome. Thank you for your answer.
Well, we are right on time. Thank you very much, Imen, for your speech. Now we will have a 5-minute break, followed by a panel on future of money market, moderated by Isabella Kaminska.
Thank you. Thank you, Quentin. Thank you all. Bye.
For anyone that's here, is the freedom with which banks in Europe in the Eurozone get funding intraday from the ECB, as opposed to the case in the Fed, is it simply because it's a reputation effect? Since they've always done it, it's not a big deal? Or is there some other reason that there's a stigma in the US but not in Europe? Is it the terms of the facility in the ECB? Or is it just everybody does it, so there's no big deal if I do it too?
I don't know if you can hear me, but can you hear me?
Yep.
Yes.
I did a piece on this in 2019, and I was looking into the history of all these different overdraft facilities and intraday borrowing systems. And based on that research, perhaps somebody knows better, is that because the euro was kind of designed from scratch to be an RTGS system. I know the Fed was technically an RTGS, Fedwire is RTGS as well, but it was always designed from the get-go to sort of provide liquidity on tap. And so it was baked into the system from the get-go. That was my research.
Isabella, I'd love to see that. If you could either put it in the chat or send it to me by email, that would be fantastic.
So I ended up speaking to, oh, wrong one. Hang on. There's a chap called Bruce Summers who did that link is now dead. It was the evolution of RTGS, and he kind of compared all the different systems of intraday borrowing around the world and how they differed and which ones charged fees and which ones required collateralized positions and which ones didn't. Anyway, that link is now dead, I think. But if you look up evolution of RTGS, the base document that informed me was that one.
Got it.
And
I see the link now.
Yeah, I spoke to him as well, and it was quite interesting, but he was more focused on the US.
I think the piece you refer to is also very important in this story, because that's where the big needs for intraday liquidity comes from, the introduction of RTGS. And I think that's the point you're making in the one you're referring. That's why it's at this point that we started to need these very large or unconstrained daily overdrafts. And I think part of the story is that back in the days, it was impossible to imagine a system with enough reserves so that banks would be satiated in terms of intraday liquidity within a RTGS system. But now, as a consequence of QE, we kind of move to that world de facto. And probably what happens that some regulators were happy with this situation, and they decided, they reacted to cut the access to the intraday facility because it wasn't needed, up until the point where reserves were reduced, and then suddenly we realized that we actually needed this. But I think it's very much in your piece.
I just wanted to add that piece was sort of also floating this overdraft facility chart use of daylight overdrafts at the Fed. And I just noticed, because I haven't looked at it for a while, I was trying to, research it now ahead of my panel. And that chart's not been updated since February 2020. And I was wondering why. Like, it seems, I've just put it in the link as well. I was wondering, had something happened to the system of overdraft facility, daylight overdrafts? Well, we'll talk about it in the panel. Maybe others will know.
That's a great question, Isabel. I've been kind of badgering them for a while to find out what exactly happened, and it's actually a bit of
really? Oh,
Yeah,
good.
yeah.
It's not just me. Okay, great.
No, no. I mean, when it first started to disappear, like most things that I know, I learned it from Luke Randall. He quickly was on top of the fact that that they stopped publishing that, and it remains a mystery why they did.
Well, we
so-
can talk about it in our panel. That sounds that's really, I'm glad that I thought it was just me, because sometimes you don't know, you think maybe you're just being a bit paranoid.
Right. No, it's a really it's a mystery and a good question.
Isabella,
I
if
thought-
you it's 4:35, so if you want to start the panel, we're good to go.
Okie dokie.
I think you're muted now.
Okay,
Okay, there we go.
muted it at the wrong moment. So are we live now? Yes, great. Okay. I'm going to assume we can go now. So I'm Isabella Kaminska, and I'm the editor of FT Alphaville. Thank you very much for having me today to moderate this exciting panel about the future of money markets. We were going to have 4 participants, but sadly, Daniela Gabor is no longer going to be able to take part. She is ill, unfortunately, with COVID. So we wish her a swift recovery. Nonetheless, we do still have Bill Nelson from the Bank Policy Institute, Zoltan Pozsar, who is infamously on that. Well, I shouldn't have. Sorry, I bungled my introduction for you, Zoltan. But I was going to say, big friend of FT Alphaville, but resident at Credit Suisse, and Joanna Solin from Nordea Bank. So thank you all for joining me. I thought just to begin, if you could just quickly introduce yourselves with specific sort of reference to your expertise on money markets and how you develop that, but very quickly, and then we can move on. I think we can, rather than going into the sort of expanded questions I planned already, it's been such an interesting debate so far. We can plunge straight forth and in a kind of continuation of the chat into intraday liquidity discussions. But if you could start, Bill, why don't you give us just a brief explainer for those who don't know why you are a particularly informed person on this topic. Thank you.
I'll do my best. I am the chief economist at the Bank Policy Institute. The Bank Policy Institute is a research-focused trade for about the 50 largest U.S. banks and foreign banks with operations here. And so I interact regularly with banks on issues having to do with a lot of what we're discussing today. But perhaps more relevant, before that, I spent 24 years at the Federal Reserve Board in the Division of Monetary Affairs, which is the division that deals with not just monetary policy, strategy, and communication, but also sort of the plumbing. My particular expertise was on central bank lending, including regular lending and emergency lending. And I ended up spending a lot of time because of that expertise, actually working on the liquidity requirements part of Basel IV. So I sat on the LISIC, the Large Bank Overseeing Committee. I was a member of the steering committee of the CLAR, which was discussed earlier. And then I was involved in all of the efforts to design the LCR and the NSFR.
Brilliant. Thank you so much, Bill. And Zoltan, a quick intro from yourself and why your expertise matters here.
Yes, can you hear me?
We can indeed.
Yes. Yes, so I'm Zoltan Pozsar. I'm the global head of short-term interest rate strategy at Credit Suisse. And why the expertise? I don't know. I once did this map of the shadow banking system, and then I guess I became a plumber because of that, and then went from the public sector to the private sector, where basically my job became to just follow money markets for a living, and that's basically it.
And you are one of the most well-known plumbers as a result. Joanna, if I could extend the same question to you, thank you.
Yes, can you hear me?
Yes, we can.
Perfect, thank you. So my name is Jana Sulin, and I'm working in Nordea Bank. And my responsibility is liquidity management and short-term issuance, which are very, very related to each other. And being roughly some 40 plus years in the market in the Nordic, one of the largest Nordic banks, and today one of the 10 largest banks in Europe. So liquidity is very close to my heart. Thank you.
Excellent. So we don't have too much time, but I think we have enough time to kind of unpack some of the kind of more complex issues that have already been raised for perhaps some of the journalists watching this, because you're all very informed. But I do sometimes, myself, even though I focus on this, quite intimately, it's tough to keep up with all these new facilities, all these new, evolutions in the market. So I was just wondering, like, just as a stat, before we get into the intraday liquidity question, what is the biggest sort of evolution in the last sort of since 2008, say, and then again since the pandemic, that has afflicted the money markets, do you think? Who would like to start with that one? I'll go to Jana is talking, so go on. Jana, sorry, I'm mispronouncing your name. It's because I can't read my own handwriting.
Don't worry, that's fine. If I sort of think the biggest, if I would name a couple, would definitely be the US money market reform and the European money market reform. I'm topping that then up with all the regulatory frameworks that we have got since 2008, basically. Those have changed the life of liquidity management completely, both in Europe and in US. Those would be my favorite topics.
And what really would you say is the implication that we've seen most, like, for sort of a lay person watching this, not a totally lay person, but someone who's perhaps in and out? What is the cost of liquidity? Obviously, from my perspective, one of the biggest changes is in terms of the participation of non-banks in the whole operation. What would you say is the implication of that?
Of non-banks?
Yes. And in terms of the two policies that you've outlined, in terms of
so if we take since 2008 and we think the amount of liquidity that we have in the market now due to all the sort of flow from ECB and Fed, I think both banks and non-banks have it relatively, let's say, easy at the moment, as cash doesn't cost anything. It's very cheap. Liquidity buffers are built a lot with cash today. What sort of is slightly my worry is that when this all starts to disappear, when the billions and trillions start to disappear, and we have a whole full new generation which has never seen positive rates, never seen increasing rates for that matter, and how to manage liquidity in a situation where there's not so much. And then we can come to the intraday liquidity, which becomes even more interesting in the times when there's not ample amount of liquidity, which we all park to ECB or Fed for that matter.
So since you mentioned intraday liquidity, because it did strike me as that this seems to be the topic of the moment, and the panel is very much about the future. So, sorry, Zoltan, go on. I'm going to.
No, I just cleared my throat. I just cleared my throat. Please go on.
Okay. No, so it seems to me like the future, the panel is about the future of money markets. And it seems to me that that's where we're sitting at that pivot point now in terms of how we reduce the outstanding reserves. Can we even do this? And if we do that, how do we move to pricing liquidity in the future? Zoltan, what's your view on the history and where we're going in that context?
Well, look, it's actually, I think the question itself and the topic itself is quite romantic, because what is the like short-term future, long-term future, and this question of reducing all this liquidity. I rarely ever think of this liquidity ever getting reduced. I think we're just stuck with it. There was one central bank that tried to take some of this liquidity out, put some bonds back and take the cash out. We know how that ended. So that's touching on this intraday question, which we can talk about a little bit more later. But I think we're just stuck with all this money, and this is the future that this amounts of liquidity which the banks have to hold. And I think what's a good analogy here is Ben Bernanke right after, QE 1, 2, 3 ended, someone he wrote in a blog in response to something, when is all this cash going to absorb, or what's the future for all this cash? And then he said that over time the economy is going to grow into the balance sheet of the Fed. The Fed just put a lot, but it won't be that much liquidity for the future. So I think we will be stuck with this liquidity, and then this liquidity will become scarce once government debt outstanding and bank balance sheets and banks loan books recover over time. And then the banking system is always going from being in a state where it's asset constrained, which it is now because there's too much cash and nothing to do with it, to at some point they will be liability constrained. And that's basically the story of banking. You just go from one to the other. And we were in a regime where we got liability constrained, September 2019, and then we started to rebuild the liquidity buffer of the system. And then we had COVID, and then we just poured all this liquidity onto the system. But we will soak it up. Just think about this in terms of you had a bucket of water and it spilled on the floor, and you're mopping it. But we're mopping it at baby steps and baby speed, and then over time it's going to be mopped up.
So that segues nicely to Bill. But what is the cost of maintaining all this, liquidity? Why can't we just keep it there?
So, just to take a bit of a run at this from a few steps back, I would say that the biggest change that we've seen over since 2008 has been this shift from banks managing their liquidity by actively using the interbank market at the end of the day to one where they simply adjust buffers of vast quantities of liquidity that they keep at the Federal Reserve. I think that is a reflection of the sort of the growing role of the Federal Reserve in the financial system and in society due to its, to a large extent, due to its increase in its balance sheet. I'd say that that's sort of, in some sense, one of the costs that I perceive is that instead of being sort of a reasonably sized institution with a very light imprint on the financial system, the Fed is now the largest borrower, or rather, borrower in the unsecured and in the secured market. It keeps expanding the range of its counterparties. I think that's unfortunate for the Fed. I think it's not good for our free market economy. I also think the Fed, I think just as sort of the Norges Bank reported when they decided that they didn't want to keep reserves abundant, but rather wanted to move back to a scarce reserve framework, they thought it was something important was lost, that banks were no longer, taking responsibility for their own liquidity arrangements. I see the same problem going on here. It gets to something that Jana mentioned and the previous speaker mentioned, that as banks and bank managers and bank supervisors and rating agencies all get used to a superabundance of reserve balances, and that then are cheap because IORB rate ends up being above market rates. They get accustomed to every liquidity problem being solved with reserve balances, and it becomes that much more difficult to sort of move back to a regime where banks hold a variety of assets as to meet their liquidity needs. So I'll stop there, but have plenty more to add, and I'm sure the conversation will offer opportunities.
Well, there are so many interesting strands. And first of all, I just want to say, if you want to chip in on any comment, because this is a virtual panel, it's sometimes hard to read. So do put your hand up and wave furiously if you want to make a relevant comment, and I'll bring you in. But yeah, so I mean, you say that the regime has become, well, essentially banks have become used to this cheap liquidity. But what I'm trying to understand myself is what is the cost then? Why? Because nobody really has explained why it is essential that we move off. I mean, you mentioned it's an imposition on free markets, but is that the only issue, or is there another one other than that?
Oh, no, there are additional issues. So one, and George Selgin, who is a panelist tomorrow, I think has highlighted this the most, is that it used to be that when the Fed operated with a scarce reserve framework, it could legitimately deflect pressure from Congress to use its balance sheet to fund various activities by saying we can't expand our balance sheet, because if we were to do that, we would lose control of interest rates, because it requires that reserve balances, the counterpart to those assets, be kept scarce. But once the Fed really got the authority to pay interest on reserves, but more importantly, is operating with an excess reserve framework where interest rates are pushed down to the interest that they pay on reserve balances, there is no meaningful upper limit on how large they can go. And it becomes more difficult, therefore, for the Fed to deflect those changes. And it seems just hypothetical, but I mean, I don't know, it takes time to share my screen, but I'll just read to you, what the funding plank of the Green New Deal, for example, which was published when the first New Deal came out, which was something, as checks go out, the government's bank, the Federal Reserve, clears payments by crediting the seller's bank account with digital dollars. In other words, Congress can pass any budget it chooses, and our government already pays for everything by creating new money. So there's just a perception and a risk that the Fed could be brought into fiscal policy because of that unbounded balance sheet. I'd also point to the risk, and this needn't be the case, but it certainly is the case, that by holding, it used to be that the Fed held assets and funded them virtually entirely with interest rate-free liabilities, currency. They are now holding a vast pool of assets using short-term liabilities, completely short-term interest-paying liabilities, and are therefore exposed to a great deal of interest rate risk, like any institution that's vastly leveraged, borrowing short and holding long-term assets. Now, a central bank can operate with negative revenue and with negative equity, but I actually think it would be pretty difficult for the Fed it'd be a very difficult political environment for the Fed if interest rates were to go up, which I think they will go up, it were to start losing money, and particularly if its equity were impaired.
I think you raised very valid points, but I think in the current mood, there just seems to be, to me, a kind of perception that these are not really, that the market keeps telling us that these are not concerns we should be worried about, that we can handle all that sort of excess liquidity because the economy needs it, we need stimulation, et cetera, et cetera. I mean, Zoltan, you are of Hungarian extraction, and one of the things that I've been pointing out for a long time is that this leads us into a sort of Soviet-style ghost banking system where the central bank becomes sort of too big to fail itself. Do you think that's a valid concern? That seems to me what Bill is sort of implying.
Well, ghost bank. Look, I think what the issue here is, because every time we bring up the big central bank balance sheet, too much liquidity, the banks are safe. So. But as I was listening to the earlier comments, a couple of things came to mind. First of all, I think the bank liquidity portfolios are extremely nimble, and the mental image you want to think, the mental image you want to have when you think about these liquidity portfolios is not that bank X sits there with X amount of cash at the Fed and or any other central bank and nothing happens. I mean, all these banks make relative value decisions. Some banks spend all the reserves they have and they buy treasuries, okay? Sometimes, treasuries on asset swap yield better than reserves at the Fed. Sometimes lending dollars in the FX swap market yields better than cash at the Fed. Sometimes lending your reserves in the repo market yields better than in the Fed. So, at this moment in time, we happen to be in this environment where basically all these yield alternatives that I mentioned yield worse than keeping cash at the Fed. But there are times when these reserves are actively traded. So it's not just that this money is sitting there. So that's number one. Number two, it's interesting in my case, I guess, because when I stepped into covering money markets, it was in 2015, and 2015 was the year when Basel III was rolled out. And so, I often joke that my understanding of the money markets is, the understanding of a 6-year-old of the world. This is the only regime I really know well when it comes to money markets, because this is the regime I lived. Okay, so I listened to Bill. Bill lived many different regimes, so maybe he has nostalgia for some of this old stuff.
He might take that personally. If it's sorry, Bill.
Probably he will take that personally too. But I think this is a beautiful regime. This is a regime that works, and so it is just what it is. But it's new. But if it's new, it doesn't mean that it's not good. I mean, you brought up my Hungarian heritage. I think this is like going from a centrally planned system to a private economy. Old versus new. Some people like this, some people like that. There is certainly in today's banking system, private money and public money are far more intertwined than they have been. Because remember, 2008, the problem was that we had a purely private money system, and we learned that, one bank lending to another in the interbank market, that was that other bank's, the lender's liquidity buffer, and that did not work. So we know that system failed. We also know that, there's nothing that can undo public money. And also, when we think about large central bank balance sheets, I think we also have to think about the circumstances of other central banks in the world. Think about the ECB, where, the path to QE wasn't the mortgage crisis. It was too much debt in the south and too little debt in the north. And, this is just kind of doing some covert redistribution, right? No way back from that. In Switzerland, the SNB's balance sheet increased because the big neighbor, the Eurozone, had to do what it had to do. So you needed to adapt to it, okay? In Japan, something similar, too much debt. You had a country with a higher debt to GDP ratio than anyone. So the central bank started to monetize that stock, put yen into the system. And then, all those flows of yen getting swapped to dollars and getting reinvested in the US, these are just gigantic flows. So in this global context, to even believe that the Fed can somehow shrink the balance sheet and that we can go back to the scarce reserve system, where the Fed's balance sheet is much smaller and we operate on a sliver of reserves, I don't think that's realistic. I do also appreciate that there's this risk of the central bank getting swept up in politics and doing the bidding of the government, the Green New Deal for example. But again, that I think is also, when you look at things over the span of 100 years, you will learn that the central banks are sometimes more independent than at other times, and we are getting into this environment where perhaps through central bank digital currencies, the central bank is going to be involved in bidding some of the, doing some of the bidding of the government, and that's natural too. So I don't think that we need to fight any of this. I mean, you have masters all over the system. You have the regulators that regulate the banks. You have the politicians who are ultimately the masters of the Fed. And no one is immune to these things. So we just have to watch the way the system evolves. But I don't think that it's possible to go back to the past at all.
Thanks, Zoltan. Before I get Bill's response, Jana, what are your thoughts on anything to add on that general overview?
I actually think Zoltan took it very well. It is difficult to go back. Then again, saying that, I think at some stage something must happen. We can't continue the way it is precisely now. Tapering has to come at some stage, and I suppose in US, the longer we haul with very low rates, maybe at some stage we will get a quicker, steeper yield curve, and the tapering is a must at some stage. What comes to the European rates, Positive rates will happen at some stage. Will I ever see them in my banking life? I'm not sure, but it will happen because, you know, nothing goes forever. So if we look at the world around us and what is happening, I think it is actually very comforting to be in the situation where we still have so much excess liquidity in the market. Looking at Afghanistan, looking at Kabul, you know, what is happening there, all the things that are happening now. We haven't seen the end of COVID for sure yet. What are the next things coming into the market, and how will the market react, you know, to the new things which are coming, which no one of us knows, luckily, maybe. So we are in a very good place to step up again, but I think we have to at some stage start to take steps backwards as well, because this can't be the fully new normal going forward either, in my mind. Thank you.
Bill, maybe you might have some comment on to the previous speakers made interesting points that I thought might be relevant. One is this anecdote that Daryl Duffy, you know, told us about JP Morgan not lending because of the change in the regime and the sort of the fact that you had to have the intraday liquidity on hand irrespective, and it's the whole Charles Goodhart idea that even when there's an emergency, you've got to cling on to that extra liquidity, and that becomes a kind of weird self-imposed stigma almost. And then the other point was regarding the lack of the stigma for intraday liquidity being used at the ECB, and just how we can live in this global sort of system with different sort of perspectives on what stigma is and isn't. Is that a strength, or is that a weakness, or does it perhaps open the door to a massive sort of risk on the table from a change of consensus regarding what is and isn't stigma? So it isn't stigma at the ECB at the moment, but maybe, you know, something might turn on a dime and it does become a stigma. So those are roundabout ways of asking about, you know, it just because something is consensus now, will it always be? And if it isn't, will there be a sort of self-adaptation to create new stigmas?
Sure, happy to discuss that.
I hope that made sense.
Yeah, I think so. And I think those are really important issues. And they highlight issues that are important to this whole topic that we're discussing, which is the way in which institutions and, you know, get used to a new regime and the difficulty that can create to adjusting back, and remembering that this was supposed to be an emergency regime that we moved into. So there was, of course, never any stigma at all associated with daylight credit in the United States before 2008. Now, there's been stigma associated with the discount window since the founding of the Federal Reserve System, and that's not something that's going to. I spent at least 10 years trying to work on that, unsuccessfully, spectacularly unsuccessfully, but nevertheless, there was never any stigma associated with daylight credit, and the fact that one had developed. That became clear, you know, in the discussion 2019 about the September 2019 events was a bit of a surprise, but I think it really illustrates what's going on. So once the level of reserve balances had grown to the point that daylight credit became rare, it then became something that required an explanation. And once it requires an explanation, you know, with your examiner, then it becomes something that your supervisor wants you to avoid, and it just becomes built into the system that you avoid daylight credits. Now, I've actually spent a lot of time with the folks at JPM talking about Jamie's remark, and you know, there's a variety of interpretations. One was just that the best way to avoid running an overnight overdraft was to not get into the realm of having a daylight overdraft. One that I actually heard from another institution, another GSIB, was that it is a requirement in your resolution planning that you not anticipate running a daylight overdraft. And if you do run a daylight overdraft, then that makes it harder to justify your the idea that your plans under stress are ones that you won't run that. Of course, that's a very marked difference from what was the case earlier when banks ran overdrafts all the time, and there was nothing. It was actually similar to what the previous speaker, the keynote said. It wouldn't be something that you would even think to mention to an examiner because it was so ordinary. And I think that's sort of how the high level of demand for reserve balances has gotten knit into the system, and how it sort of gradually needs to be brought out, untangled. I was speaking with I think the CIO of one of the largest US GSIBs during the period when the Fed was shrinking its balance sheet and interest rates had reshifted so that market rates were actually a bit above IOER, and we were talking about the dynamic of making the decision to economize on reserve balances under those circumstances. JP Morgan famously, and as Jamie was referencing, made a big shift down in 2018, the first of many, and a lot of people were sort of eyeing that possibility. Anyway, the CIO explained that, well, we were we're only required to hold like 3 days worth of cash in order to meet our liquidity needs. But we hold a week's worth. And we were thinking about, well, because repo rates are now above IOER at that time, of switching into holding repo instead, which would have been completely in compliance. But we recognized that if we were to do that, our supervisor would still require an explanation for what we were doing. And that explanation just wasn't sort of worth the marginal increase in benefit. And so, my vision is that what will ultimately happen, and I think that ultimately the Fed will stop buying assets. It will roll over its maturing liabilities, maturing principal for a while, and then eventually it will start, allowing those securities to decline just as it did before. Ultimately, that will mean that repo rates will move above and other money market rates, again, creating an economic incentive for banks to economize on their reserve balances. And it can be a very gradual process. What's necessary, though, is what was the missing part of the story in September 2019 was that once there is that small amount of tightness in reserve balances, as was clearly there since 2018, the Fed again has to keep an eye on large volatility in reserve balances and do the job that it's done before. What was extraordinary about September 2019 wasn't the big swings in tax payments or security settlements. All of those things were perfectly ordinary, if moderately large. What was different was that the Fed didn't step in an environment of slightly tight reserve situations and manage the volatility in reserve balances. So I think with those ingredients together, it is possible to get back. Can we get back to where we were before of excess reserve balances of 25 billion? Of course not. That's not where we're going. But there is plenty of scope for the Fed to get a lot smaller than it is now. I think you're on mute, Isabella.
Sorry, I'm conscious of time and I do want to get some questions in, but I did want to just weave in 2 points that were sent to me. Well, the first one, Bill, is your point. Is anything important going to be lost when we move to an unsecured interbank market regime? Because this is being, we've heard it referenced today already, but it is certainly at the moment seen as sort of smooth sailing. I don't see the sort of, I don't see a lot of discussion about, maybe it is in the sort of very expert zones, but not in the mainstream. We don't see the sort of concerns about what will be lost. It's seen as obviously building resilience and everything is posted towards a better framework. What are your concerns?
I do want to say at the outset that I think that this is a very reasonably debated point, whether or not it's important that the reserve, that banks manage their liquidity in the interbank market rather than letting the Fed sort of control everything. Plenty of my colleagues who I have, incredible respect for, including, Zoltan, have different views. And I think that I don't think that this is a home run thing. And maybe I'll never be a good academic because I don't believe with 100% in my current views, but I think it's a legitimately debated point. But with that, so, we've certainly moved to a regime now where unsecured interbank market in the Fed, the federal funds market, has, for all intents and purposes, gone away. I mean, it still exists because some institutions that don't get interest on their accounts, GSIBs, FHLBs, or rather can only get the overnight RRP rate, can lend to banks, and then the banks in those in the Fed funds market, and then they split the spread. But the use of that market as a place where banks economized on liquidity, and then at the end of the day, those with excess lent to those with that market isn't there anymore. You know, in the case, so I guess the Norges Bank saw that as enough of a loss in some sense that they switched from an abundant reserve system back to more of a scarce reserve system. I'm sure that there are lots and lots of participants in this conference that can better describe what actually happened there, given the Nordic location. But I think others have pointed to the value of banks having to remain sort of credit worthy enough, large banks, to be able to participate in an unsecured market on a regular daily basis. I see that as valuable. I don't know, weighing it all, I think it's kind of a tough call.
Zoltan, what are your views?
Well, two thoughts perhaps to add here. The first one, before our panel started, there was this question about why were statistics about daylight overdrafts discontinued. I think, but I don't know for sure, but I think these things get discontinued when the sample size gets down to one bank. So in this whole conversation about, yeah, JP Morgan stopped lending, but who was borrowing? And I guess I can say that now because I wrote about this. The bank that was borrowing those daylight overdrafts was the bank that was the most central to the Treasury securities getting cleared and settled process, right? So don't forget, the Fed is not buying treasuries anymore, so the private market has to absorb more, which means that the dealers have to take down more securities. The dealers are depleting their clearing accounts at BONY. Some of those dealers are going into an overdraft with BONY, and so then BONY has no option but to go to the Fed and take a daylight overdraft from them. And then, once you take that daylight overdraft, you have to clean it up by the end of the day. So the dealers have to repo the treasuries to get the cash to give to BONY, and then whatever is left over. So that's the process that was pressuring repo markets. And JP Morgan was instrumental in lending into that process, okay? And, JP Morgan leaving its regulatory imposed, you can't have fewer reserves than this level, is one part of the problem. But I guess, the heart of the problem was that there was that one institution that was basically using up all the daylight overdraft simply because of their place in the system, right? And, their daylight overdraft problems were just as much a problem of, dealers running out of their cash but the clearing bank's reserve balances are largely a function of, whatever cash balances the dealer community keeps with that bank. So I think that's just something to keep in mind. And so the second point is a related point, which is that, when we talk about the Fed funds market, and I've learned this from Perry Merling, who is on this call. What was the Fed funds market? The Fed funds market it begins during the day, right? So the Fed, before the financial crisis, before 2008, was extending daylight overdrafts, as Bill mentioned, to every little bank in the US. And it was typically the regional and the smaller banks that needed those daylight overdrafts because they had outflows, and the money was going to the big banks in New York City. And then the daylight overdrafts must be paid back by the end of the day, because if they don't, you get rolled over into the discount window, and then you get a letter from the Fed, and that's not a good thing. But basically, the money that was created intraday by the Fed, another thing Perry would say that, the payment system is a credit system. So this stuff needs to happen that way. JP Morgan was lending into the cleaning up process, right? Because JP Morgan was giving its excess reserves to these banks in the Fed funds market such that these banks could pay back their daylight overdrafts to the Fed. And we would never see this stuff because, you know, the Fed prints an end of day balance sheet snapshot, and all the banks print an end of day balance sheet snapshot. So this intraday stuff you never really see in the data. And so that's the old regime. And you need to be fine with the new regime, because in the new regime, it's still JP Morgan lending those excess reserves in 2019 into the repo market, or sometimes into the FX swap market. It's just that, you know, I termed it a token system because this process is like pre-funded. So some people have the tokens to just kind of throw into the system, you know, but you know, the Fed is not a part of this because, you know, QE basically foams the runway for all these liquidity mishaps. But sometimes these liquidity mishaps just happen because you had some regulation that you imposed. But so those are the two things that I would say. So again, you know, from my, you know, 6-year-old's understanding of the world, this is okay. It's just different.
I mean, I think there's so many interesting points. We could talk about it for hours and hours. Jana, I would love your view as well. And just weaving into that, you know, I understand that there was at some point in the history of the Fed an expectation that the overdraft facility would not become the prime sort of go-to area for liquidity, that they wanted a sort of daylight liquidity market to develop in its own right, but that never happened. And I was wondering, Jana, don't feel, you know, it doesn't have to be answered by you, but if anyone knows, you know, where we are on that sort of stage of development, that would be quite interesting. Why did it never happen? Does it need to happen as a process of sort of moving us into an increasingly real-time world where instant payments are effectively not just for, you know, it's on the interbank basis, but also on the retail basis across the board, right? And the Fed now universe, so to speak. Go on. Oh, yeah, I think you're on mute.
You're on mute.
So,
go ahead, Jana. Yeah, sorry.
okay, yeah. So I don't know if I do have the answer, but clearly, sort of looking at the demands for a bank today, Zoltan, I think you mentioned it quite well, that sometimes, you know, you have that excess, sometimes you don't, because looking from a European perspective and looking from a Nordic perspective, where Nordea is in the 4 Nordic countries, having relatively many liquidity ratios to adhere to. And then intraday, of course, becomes very crucial for us, because if you start from the morning and start with CLS payments and everything, the more and the better infrastructure you have to cater for your payment flows, the better you are basically off. And interestingly, I can't remember, was it Bill Yu who said that the interbank market as such is gone? Yes, definitely. It is gone in the way we sort of 20 years ago thought about the interbank market, especially probably in US and Europe. But then I have to flag again that we have to remember that banks still need somehow to cover all the other currencies that we serve for customers, you know, starting from Kuwaiti dinar or whatever. So somehow that credit market is still there, and it will prevail until we come to a you know, electronical form of a central bank clearing system for all currencies, not only for euros and dollars and sterling and Swiss francs, but we need that for basically all currencies. But intraday is definitely something which is quite expensive, even in today's negative rate world, if you start looking at it, because, you know, having the buffers to sit on your regulatory requirements on intraday is expensive. And one could say that at least if you have a very conservative credit policy, it is expensive. So depending, of course, how you can invest your buffers, the cost is different for different banks, but intraday is something that everyone has to start looking for, because that cost will be intolerable at some stage going forward. Thank you.
Yes, and perhaps to just chip in with one more thought to what Jana just said. The domestic unsecured interbank market, for sure, is I think over for all intents and purposes. But the global secured interbank market is alive and well, and it's the FX swap market, and the volumes that go through there, you know, U.S. banks lending dollars to Japanese banks, you know, Scandinavian banks with balance sheets and excess dollars lending to European, Australian, Japanese banks. I mean, that market is doing fine, and that's there. And then, you know, the domestic interbank market, the repo market, at the moment is kind of asleep, but it wasn't in 2019. But you know, these secured markets are basically the interbank markets that are alive, because secured, I think, was just killed by the rules, because you're not supposed to lend any of this stuff unsecured anyway. So that's just an additional thought.
I think these are all fascinating points. I really want to take some questions from the audience at this point. So if anyone does have any, put them in. I'm actually not sure how I can do that on this technology, but maybe if people want to wave furiously at me, I'll know. Sorry for being a techno.
I will let you know if someone raises his hand or has a question.
How do I know? I don't know.
I will let you know.
Okay, excellent. All right, so I'm going to pretend there isn't any. But so we're kind of like touching upon the sort of two strands, and maybe we can talk about this as we wait for questions. First of all, is how this market will evolve as and when CBDCs come into the frame, if they do, how that changes the picture. But also, I think this like reliance on FX swaps and what Jana was talking about is a kind of a subtle reference point to the fact that the risk in the system isn't just about domestic risk. It's about how all the different central banks interoperate with each other and the FX exposure. So sort of going back to the days of Herstat risk, actually. So if any of you have any thoughts about those, do raise your hands, panelists, that is, whilst we wait for questions. I've just realized I do have one question, but I'll come to that in a second. Nobody wants to take a stab at the CBDC future and or how go on, Zoltan.
Well, maybe I you know, I have been thinking about the CBDC stuff because it just wouldn't go away. So you know, 2-3 years ago, I thought maybe this is just some I don't know, but you know, it's still around and it's gaining momentum. So I think there's two ways you want.
But it is ultimately the pre-funded world that you're talking about, CBDCs, right?
Well, it is a pre-funded world. It's a pre-funded world for non-banks, yes. Which again, you know, you want, like, it's like, why do I need a central bank digital currency? I can Venmo for my coffee. I can use a credit card. I can go to the, I mean, I don't need it, frankly, right? So it's like, why are we pushing this? So look, the way I would just think about this for now, and then I guess we are all trying to figure this stuff out. But by the way, I think central banks have written a lot of papers about, you know, this is the way it would work and why not. I think I'm waiting for the paper that says, why do we need this, you know, from the central banks? What is the problem we are trying to address with central bank digital currencies? I just put that out there. But the two thoughts, you know, central bank digital currencies, you can think about only as something that the central banks do on their liability side. So like, let's open up our balance sheet to the public, so that, you know, Bill and Isabella and Zoltan and everyone on this call can have an account with the Fed or corporations or whoever. I don't know how broad they want to go. So what does that mean? Okay, well, I can now move my money from the bank where I keep my deposit at, and I can have my direct account at the Fed. And then that bank is sure as hell going to have a funding problem. And then a central bank is going to have to fund the bank because the bank just lost deposits and the money went from the bank to the central bank. which basically means that if you think about central bank digital currencies only on one side of the balance sheet, it's inevitable that the central bank's balance sheets are going to have to expand, right? Because as they offer this new product, they will also have to offer something on the other side, which is funding the banks that just lost funding. Why exactly that's a good thing, I don't know. So now, which kind of opens up the second option, which is that probably the best way to think about these central bank digital currencies is as one side of a coin. You know, everything in banking has two sides. You know, banking is all about balance sheets, right? So if you talk about CBDCs, we are not talking about, you know, other stuff that would happen on the asset side of a central bank. You know, Bill mentioned, for example, this Green New Deal stuff. You know, there are projects, I'm sure, that are out there that no private bank would finance because the payoffs are uncertain or the payoffs are so far into the future. Again, putting a solar panel on everyone's rooftop. Like, why would a private bank finance that or something like that? So maybe central bank digital currencies are going to be vehicles to kind of lend into projects and finance into projects and you know, lend to certain parts of society that are unbanked or whatnot. And that way, you can have central bank digital currencies that you imagine as there's a new asset, a new loan that's getting created by the central bank. There's new money that's getting created in that lending process. Banks make loans, create deposits. And instead of central bank digital currencies being a vehicle to kind of suck deposits away from the banking system and then figuring out how to fund the banks, is actually net additive to the money creation process. And so there's going to be like a two-way flow. Some people are going to move money from bank deposits, central bank digital currency, but people that were given central bank digital currencies, they're going to spend it. You know, they're going to buy their solar panels, and then the solar panel manufacturer is going to keep that money somewhere. So I don't know. That's the way I would think about it. I think what's missing from the debate is that it's very one-sided. It's a liability side concept without a matching asset side component, and I think probably that's the hidden agenda, if you will, or that's the natural evolution. I mean, look at the Fed. I mean, we went from RRPs to RRPs and swap lines to swap lines with 10 extra countries, the standing repo facility. It all started on the liability side.
Yeah, but doesn't that push this of independence issue? Because as the central bank becomes more like under pressure to put that liquidity to work, it has to make investment decisions, no?
Yes. Well, look, Roosevelt took the dollar off gold. These things happen. You know, if you know, we are living in an unequal world where, you know, private capital did a lot of good, but private capital didn't address a lot of things. And I think some of those things will have to be addressed, and perhaps, you know, this is going to be a vehicle that we will use to address some of those issues. But again, you know, central bank independence, and you know that here's another little thing from, you know, Harry talks about the expansion of the credit system and money and credit and what is this and what is that. And I think in a similar fashion, the distance between the fiscal authority and the monetary authority is like that too. Sometimes they meet up and sometimes they are distant. Right now, when inflation is not a problem and growth is not as equal as it could be, I think that distance, we have been observing it. It's been coming ever closer.
So, sorry to move on to Bill, but Bill, what's your thought? What are your thoughts on this topic? And also, I have a very specific question for you after that from a audience member. Go on.
I think Zoltan raises a really good point about there being, it's just not that clear what problem the central bank digital currency is intended to solve. My colleague Greg Baer has written a really nice note sort of highlighting how there are different problems that have been mentioned. Each of them is sort of mutually exclusive, you know, solving, overcoming the people's reluctance to have a banking account by, you know, through financial inclusion, one of the things that you hear, you know, but can that be done at the same time that you know, comply with AML requirements and other things? There's just, I think that, and I do think that this is a message that you've heard from.
Would the CBDC be open to the Taliban, for example?
Well, for example, that's right.
Sorry, that shouldn't, not a laughing matter, but the idea being it's about the extent of reach, yeah?
But I'll highlight two other issues, or at least one other issue that hasn't gotten, I think, a lot of attention. In addition, so in a situation where there was a very large inflow into CBDC, like you can just think about last March 2020, what the inflow into CBDC would have been under that. It would have been vast, probably on the order of $1 trillion. That would correspond to a reduction in reserve balances. That's the way the central bank balance sheets work. When one liability goes up, another liability goes down. At least that's the immediate effect. And the Fed would have to hold a buffer to manage against those declines. So not only would there be the large increase in assets that the Fed would have to hold just to offset the CBDC itself, it would have to hold a buffer above that if it wanted to continue to operate in a floor-based system, so that it remained above sort of the structural demand for reserves, even when there'd been a big inflow. So, and an even larger balance sheet would be required because of that added volatility in reserve balances. One other point I'd make is one of the advantages that's been pointed to by some monetary economists for CBDC is that it would allow the central bank to get below the zero lower bound and charge negative interest rates by charging those rates on the CBDC. But in order to do that, you would have to put restrictions on currency. That's the whole reason why the zero lower bound exists. But once you put restrictions on currency, you don't need the CBDC to set interest rates quite low on negative. You can do it just using the current mechanism, as the ECB has demonstrated perfectly well. So it's actually not a special feature of CBDC that brings that benefit to us.
So I've got a question specifically for you. It says that you've previously discussed the possibility of using a committed liquidity facility as a partial substitute for reserves. Could you elaborate on how the use of a tool like this might change money markets in the future?
Sure. So maybe I can also just start by explaining to the audience what a committed liquidity facility is. So as part of the LCR standard, one of the types of high quality liquid assets that can be included is what's called a committed liquidity facility. It's a committed line of credit from the central bank. It's collateralized in the normal fashion of central bank credit that a bank would pay a fee for, established an amount, and that amount would count as HQLA. That has always been part of the LCR, but it's always been restricted to jurisdictions that have a shortage of HQLA. So Australia, South Africa have used committed liquidity facilities. As I mentioned, I was actually very involved in the design of the LCR, particularly after and led a number of BIS working groups and participated in many others. And my special thing was, I really thought that committed liquidity facilities should be available to all jurisdictions. And ultimately they were made available to all jurisdictions, but only at sort of a rate that was actually not workable. The advantage is that a line of credit and a deposit are effectively economically the same thing. They are both a promise by the bank or the central bank to provide funds on demand when needed. And the committed liquidity facility would be a way to, first, it would have a number of advantages. One is that a central bank could charge people for something that it's currently giving away, which is effectively the option value of borrowing from the central bank. Another is it would better measure institutions' liquidity, because if you have collateral pledged to the central bank and you're able to borrow from the central bank, you're more liquid than an institution that doesn't. So not incorporating that into your assessment of liquidity is a shortfall, but has distortionary impacts. One other advantage is that it allows the central bank to, reserve balances can be even smaller. One of the thing that I'd mention is it's at least possible that it could help reduce stigma associated with borrowing. And that's because if you have something that's sort of prearranged, that's discussed in advance, that's discussed with Congress in advance and the public in advance, that you pay a fee for, there's at least some case to be made that would be, that banks would be more willing to actually use that facility when push comes to shove. I think that'd actually be important to determine. Sorry, that's sort of a crash course on committed liquidity facilities.
I think it sounds fascinating, and it does sound like a really interesting halfway point, which could destigmatize, as you say, that inclination to borrow when needed. So we are literally a minute away from our finishing time. I really do feel like we've only just scratched the surface. I think we've got 3 minutes potential eaten into the break time. If Jana or Zoltan have any very urgent follow-up, wave if you do. Otherwise, I don't see Zoltan waving at the moment. He's standing in front of a very sort of GQ-esque kind of backdrop. But okay, on that note, I think we will close it there, even though I really do wish we could continue the conversation. Thank you so much for participating. It's been really interesting.
Thank you, Isabella. Thank you, organizers and panelists.
Thank you very much.
Thank you for leading the panel.
Yeah, thank you.
It was fantastic. Thank you very much to all the panelists and Isabella for the great moderation. We will follow up in 5 minutes on the academic session on money market pricing.
And we finished exactly at 4:35.
Yep.
Perfect.
Bye.
Thank you. Bye-bye.
All right,
Nice
take
to see
care.
everyone. Bye-bye.
Thank you, Isabella. It was great. It was fantastic.
Yeah. Take care.
Angelo, do you want to share your slides? Perfect. Yep. So I can see you. I cannot hear you at the moment. Do you want to make a quick test of the microphone?
Hi, Adrian.
Yeah, perfect.
Is it working? Good.
Yes, fantastic. Thank you.
Very good.
All right, we start in 2 minutes.
All right, and we are ready to go for the first paper of this academic session on money market pricing. Angelo Ronaldo, the floor is yours.
Thank you very much, Adrian, and thank you very much to the organizers for having this paper, this terrific conference. Thank you very much. So the paper, in a nutshell, is an asset pricing analysis for repurchase agreement. Okay, so and here I would like to draw your attention on what is a repo. After all, the repo is cash for asset, right? So you get cash if you pledge asset, or if you want the asset, you need to give back the cash. And I think what was missing in the previous part of the conference, despite the fact there was a really amazing keynote speeches and panel, is the asset side. We really have been talking a lot about, you know, central services and so on, but the asset side, it's also important like the cash side. So what I'm going to do, roughly speaking, in this paper, me and Benedict, by the way, this is a joint work with Benedict Valensiefen, who is a PhD candidate at the University of St. Gallen and also working in the World Bank. So in this paper, essentially, we are going to propose you two pricing factors. One is capturing the cash side when you think to pledge any possible collateral eligible. So it's going to capture the average market value of the services. And the second pricing factor instead will capture the heterogeneity of the collateral asset value. Okay, so having only two pricing factors, you can explain essentially the price variation of repos. So that's the paper in a nutshell. So we provide, you know, a systematic asset pricing analysis of these repos. We are going to show you that a standard factor model with only two factors, one capturing the level, the market level value, and the other capturing the slope, is a slope factor, capturing the heterogeneity, the variation in the collateral values. You will be able to price these near money assets, right? So the point of view that we will take in this paper is that, after all, the repurchase agreement is an important category of safe asset. So we are going to explain the pricing of repos through the lens of the safe asset literature. Why? Because the safe asset literature indeed postulates that safe asset can be different. You deviate from the risk-free asset concept, and indeed there could be, you know, heterogeneity in them depending on the convenience yield they offer, right? What do we mean by convenience yield? Well, a safe asset is safety. It's safe, it's secure, so give you protection against the bad state of the world. And second, is also provide you liquidity benefits, liquidity services. Okay, and then these liquidity services are valued by market participants because, for instance, an asset can be easily pledged as collateral, can be easily converted into cash, and other attributes like that. Okay, so then by looking through the lens of the safe asset literature, we will be able to explain the repo pricing. Okay. So essentially what we are going to do is to argue that an asset could be a truly safe asset, offering you a significant convenience yield, or it could be a quasi-safe asset, which in good times, it mimics a safe asset, a truly one, but in bad times, the convenience yield start diminishing, being wobbly and unstable, and therefore you want a premium for investing on that asset. Okay. So after all, the repo inherited the convenience yields of the collateral asset that secured it. Okay, and this variation in the convenience yield of the collateral asset explain the represent essentially the slope factor in the pricing in the standard factor model. Okay, so we contribute to the two strands of the literature. First, the asset pricing, and second, the safe asset literature. The asset pricing, of course, because we provide, if you want, the first systematic asset pricing approach for repurchase agreement. The safe asset, because we show that this important category of safe asset can be priced and how you can do that. Okay, so we study empirically the European repo market. Why we do that? Well, because essentially it has many advantages. I'm going to mention three of them. The first one is the collateral side. The Euro repo contract are secured by a variety, many different assets, and typically there are government bonds with heterogeneous safety and liquidity attributes. It could be a German government bond, it could be an Italian government bond, and so on. And by having a different sovereign, being floating in different secondary markets, they have different qualities. This is going to give you a difference in the pricing for values. Second, the market characteristic of the European repo market is very interesting. Why? Because without going to technicalities, but the market features enable us to isolate these two factors, the different convenience yield affecting the repo pricing. For instance, the European repo market, the main segment is centrally cleared. So then homogenizing, if you want, the counterparty credit risk. Second is a very short-term oriented market. So there is no term premium in the repo itself. It's an interbank market populated by professional traders that know what they do, sophisticated traders and so on. And third is indeed the largest market in the world. Okay, so it's highly liquid, and we have the data set that capture 70% of the market share. Okay, now let me move to the flag you this figure showing the time evolution of some important repo rates in the euro market, right? So you see different colors. The green lines are more representing Germany when the collateral is issued by the federal Germany authorities, or the France, right? Representing, if you want, the core countries of the euro area. The blue lines instead are more representative for the periphery of the euro area, which is, for instance, Italy and Spain. Okay. Along with that, you see also a dashed black line representing the DFR, the deposit facility rate at the ECB. And what you see are some interesting patterns. First is there is, of course, a downward trend of the repo rates. Altogether went down, but nonetheless, you see cross-sectional variation among these four rates, right? Especially in distress period, like the European sovereign debt crisis in 2011 and 12, and then again in the 15, you see that there is variation, and typically what you're going to see is that the core country rates, so the green line, are hovering below the blue lines, the periphery rates, okay? So suggesting that there is some variation, even if there are really same overnight rate and traded on the same market, there is variation among them. And this holds true, and that's the second point I would like to stress, even after 2015, right? When indeed an important share of the market was traded below the deposit facility rate, right? So if the peripheric rates were moving along the DFR, the core country rates were traded below the deposit facility rate, right? And then you see also spikes in some occasion, right? Especially downward spikes driven by the core country rates. Okay, this is an important sign that the market became collateral driven after 2015, right? And it's important because after all, what we claim is that the collateral is an important driver for the repo pricing. Okay, so now how we create this carry factor, right? The market factor is just the volume weighted rate, taking into account all the 1,000 different collateral assets that you have in the market. Instead, the carry factor, as the name suggests, is a carry where you take a long position on the high rate. So taking a long position on those repurchase agreements offering higher rate. And at the same time, you short the repo rate with lower interest rate, okay? So by doing that, please keep in mind that you're gonna create a cash neutral position. So by doing that, you isolate, if you want, if any, if there is any diversity in the collateral value, okay? In some sense, it's a kind of collateral swap that you create. Good, so imagine that you do that, and the European market, as I told you before, offer you many different collateral assets. So every day you take this long position in high rate and short position in low rate. Even if you can form a good expectation about the tomorrow rate, you don't know ex ante what is going to be exactly the repo rate. So there is some uncertainty. And imagine that you reshuffle this portfolio every day. You rebalance the portfolio daily and you take into account transaction cost, right? That's what and imagine that you, for a practical reason, you create 8 portfolios like you do typically in asset pricing, right? 8. So that would be the performance of your portfolios, right? The portfolio 1 is the one with the lowest interest rate. Imagine, for instance, Germany, right? And then you steadily increase that until portfolio 8, accommodating all the high rate portfolio on that day, right? So that's the average performance that you would get, right? By shortening the low rate portfolio would have a 0.35 annual return, and so on the other extreme you would have 10 basis point, right? Then you take into account transaction cost, you would have overall a Sharpe ratio of 1.6 with this carry strategy, and that's the high minus low return, okay? So the time evolution of this carry return is illustrated in this figure. You see that it's always positive, right? Even increase in bad times. And second, is still there even when the repo rates were traded below the DFR, so after 2015. Okay, so that's the carry factor. Okay, so the carry factor is still there even if you exclude special repos. So you cannot explain that with specialness. And second, even if you exclude the possible systemic risk of clearinghouse failures, is still there, and so on. Okay, so it's a systematic feature of the market. Now, let's try to dive into that. Now, imagine that you now compute the principal, you run the principal component analysis of this this repo rate across the repo rate variation. You would see that there are two principal components that explain them. The first one, as you can see, the loadings are typically the same, suggesting that every portfolio that I showed you before contribute in the same way to the first principal component, and actually cover up to 95% of the variation. So this seems to be more a market factor, a level factor in our pricing exercise. And the second one, the second principal component instead, it's very interesting. It's you see that it goes from a negative loading up to a positive one in a monotonic way, right? So suggesting that the first portfolio accommodating the low interest rate, so the one that typically have a higher convenience yield, is negatively loading on that, and the other way around for the high rate portfolio. Okay.
Angelo, there's 4 minutes left.
Okay, cool. So now you run your asset pricing exercise, FAMA French, FAMA McBax or GMM estimation. What you're gonna see indeed is that the two factors, the first one captured the market factor, the level, and the second one, you see this nice monotonic increase of the loading from a negative value up to the positive one, right? So you run your time series analysis and cross-sectional analysis, and you find exactly what you expect. These two factors are able to explain essentially the vast majority of the pricing, the repo variation. Okay, now what are the economic determinants of that? Right? Now we take this point of view of the safe asset literature. We look at the collateral asset of a repo as a safe asset. That could be a pure safe asset with an high convenience yield, or a quasi-safe asset with a wobbly convenience yield. Okay, and now we simply extend the conceptual framework, the theoretical framework proposed by Krishnamurti in 2002 in JFE paper, right? Arvind Krishnamurti was proposing a framework in which essentially the specialness in the cash bond market, the specialness would affect the repo rate, right? We generalize this framework by arguing that the convenience yield of the collateral asset can affect the repo rate. Okay, so that's what we do, and essentially what you have here is that the convenience yield varies because of the safety premium is embedded in it, and this convenience yield is going to be even larger if there is scarcity of this asset in the market. And following Nagel 2060 paper, also this convenience yield as also a liquidity premium would increase with the opportunity cost of holding money. Okay, so then we translate this idea into an empirical analysis where you have the risk proxy, basically capturing the sovereign risk of the collateral asset, the scarcity, or how many assets are floating in the market, the opportunity cost of holding money, and then other controls, right? And you see that indeed the safety premium is large for the low rate in, portfolio and is positive for the high rate portfolio. And then also the opportunity cost. If you want the low rate collateral asset retain more liquidity premium, even for an increase of opportunity cost of holding money. Okay, then we conclude the analysis also showing that these repo pricing factors are able to explain long-term bond pricing, right? Suggesting that even after explaining bond pricing variation with the Nelson-Siegel implied bond return, you see that the carry factor indeed can explain the cross-sectional variation in the bond return, and also the market factor, the repo market factor, is also significant even after controlling for the bond using proxy for the bond liquidity premium and bond safety. Okay, so it seems to be something more and some informative factors also for the bond pricing. Okay, that's the paper in a nutshell. So it's a first systematic asset pricing analysis for an important category of safe asset repurchase agreement, and we have shown that two pricing factors are able to explain that. Thank you.
Thank you very much, Angelo. So now we have the discussion by Moritz Lindley.
Yeah, if you can stop sharing, perfect. Thank you. Wonderful. Yeah, thanks a lot to the organizers for letting me discuss this very interesting paper. A quick overview over the paper. So repo, luckily in this crowd, I don't really have to tell how this works. So you borrow cash, you give collateral, and giving the collateral first can ensure the repayment. But as the authors are stressing, this part of lending the asset to the counterparty might have a benefit in itself, and that's going to be key for the rest of this paper and for my discussion. So in the data, repo rates vary across underlying collateral, and in this paper, this is particularly shown for the cross-section of rates in the European repo market, which is a very nice setting because in the European repo market, more than maybe in the US, there's a large variation in assets that are traded, just because various government bonds are traded. This market is centrally cleared, which avoids a lot of confounding factors that one might have in bilateral markets in the US, and the counterparties are usually anonymous, and so there's kind of like no counterparty risk can be excluded as in a lot of the settings. So this makes it a very nice setting to study this cross-section of rates that we observe. And then the authors find that repo rates are priced by two components: a level component, which kind of says that the average repo rate in the market, and then what they call the carry component, which measures the, I would say, the convenience yield of the underlying collateral that is provided to the counterparty. And then they ask this carry component, how does this cross-sectional, this dispersion, what can explain this cross-sectional dispersion? And so first in the time series, this cross-sectional dispersion varies, goes up and down, in particular in times of financial market distress. I would say the dispersion goes up. And then at various asset characteristics such as risk and supply explain then the loading on what they call the carry factor. So I'm going to make this discussion very short. I have one major puzzlement about like the empirical asset pricing analysis, and I hope Angelo can help me clarify what is going on there. But then in the end, I'm going to more talk about what I'm really excited about in this paper. So I mean, I'm going to start approaching this paper from a very simple, my very simple view on how repo pricing works. And I find it always easier to think about this from the reverse repo perspective, because in the reverse repo, the person that lends, like kind of in the US, the money market fund that lends in the repo market and then receives the collateral doesn't have to worry about how to purchase the collateral, have to hold the collateral in the beginning. So this lender in a reverse repo agreement invests at a safe rate and then temporarily holds the collateral. And so to think about how would this lender think about pricing, we can just assume there's some stochastic discount factor, which I call here MT+1. And then there is on this repo rate a short-term and default-free rate, RJT, on this repo contract J. So I'm going to, but what the authors are also doing, which I think is completely reasonable in the repo market, to assume this return is is default free. The authors also argue there's not enough segmentation to kind of assume there's like differential pricing currents. So that's going to be like we're going to think of it, one unique pricing current or one participant that prices various repo contracts. And so then we can do some very naive repo pricing, just saying, well, we know how to price a risk-free rate. We take the stochastic discount factor, multiply with the risk-free rate, it should equal 1. And so this repo contract should be priced as like 1 over the expected value of the stochastic discount factor. And then the problem is that we see in the data, we see rate dispersion. So this can clearly not be the right model. Different contracts I and J with different collateral underlying this contract have different returns RJ and RI in the data. And so the question is what could explain this? So if it's not default, if it's not market segmentation, if it's not about differential haircuts and so on, the one thing that was missing in this pricing model so far as well, the lender in this market receives the collateral and maybe values the collateral in itself, holding temporarily on to this collateral. And I'm going to call this collateral here this convenience yield of holding the collateral phi j. And this is now going to equalize our asset pricing equation. There is this contract J and there's this contract I, but they have different phi j's and different phi i's that now make sense of observing these two different returns on the repo contract. And what we can actually like immediately read from this equation now, what is the differential convenience yield across these two contracts? By just looking at the rate spread, we can just divide by the stochastic discount factor and then separate return differential into this convenience yield differential. And then by definition, we can now take the average repo contract in the market and say, well, the return on repo contract RJ is going to be this average repo rate minus the convenience yield that this contract J has relative to the average convenience yield in the market. So the higher this convenience yield J is relative to the average, the lower the return on the contract is going to be, because the temporary holder of this collateral gets this additional benefit phi j and therefore is willing to accept a lower return on that repo contract. And then we can rewrite that kind of more in the spirit of what Angelo and Benedict are doing in the paper, in kind of a factor writing. We can first replace phi j minus this average phi as rj minus r bar, because this is exactly how this convenience yield spread is here defined. And then we can multiply and divide by the return on the highest repo contract and the return on the lowest repo contract. And then what we have is now, when we sort repo contracts by return, we kind of have an inverse sort by convenience yield. Lower return repo contracts are trading on assets that give a higher convenience yield. And when I do this carry trade that Angelo was describing, I say I reverse repo J, I do repo I, then I'm long the convenience of asset J, and I'm short the convenience of asset I, and this is kind of this collateral swap. And this is a carry trade with no risk. I'm talking about completely risk-free assets. And if I want to describe this as a factor model, then this is a 100% R-squared factor model, because everything in this equation is observed at the moment. I can directly go to the market and I can read those repo rates and I can learn something about the relative convenience spreads. And I think this is, so just thinking about how would I now approach the data that the authors are here working with? Well, it seems like this is just an accounting exercise. I can now go to the data, back out the relative convenience yield that these assets have, and think about this cross-section of convenience yields. And so my main like critical or confusion comment is maybe, when I then go to the paper, what the authors are doing is like employ all this asset pricing machinery, do portfolio sorts, Farmer Macbeth, Hansen GMM. They find a Sharpe ratio, but these are like risk-free contracts. Like how I'm doing like a carry trade on risk-free assets. How can I even talk about Sharpe ratios? There's an 8-factor principal component analysis, but just by accounting, I can just do this as like a two components in this return. And so first I was like puzzled by how can we talk here about these risk-free returns and employ all this machinery. And I think that the way this works is just how portfolios are sorted here is done yesterday, and then the strategy is employed today. And that involves some risk now, because the repo rates that I observed yesterday might not be the repo rates that are today. And so now I have risk involved. But despite now being able to think about risk and Sharpe ratios and so on, it was not clear to me, why is this the relevant trading strategy that we would want to look at? Why not just do the accounting exercise that I just described on the previous page, because after all, this is exactly what the trader observes the risk-free rate at C, decides the repo portfolio. There's different repo rates. So first, this maybe looks like there's infinite Sharpe ratios there, and so I cannot calculate a Sharpe ratio. But of course, I can only not calculate a Sharpe ratio if I'm not accounting for the convenience yield, or even better, if I'm not accounting for the cost of collateral. Because if I want to do this carry trade, I have to buy for example, I have to buy the German bond to then provide the German bond, borrow at a low rate, and then get the higher rate in the repo market. And so there is, of course, a cost involved. And do these infinite Sharpe ratios that we observe then mean there's an arbitrage? No, we need to buy the expensive collateral asset. And as the authors are showing, this current and future convenience yields, they're then priced into these assets because I'm getting those convenience yields. Is there an expected excess return? This like goes to what Angelo was talking about, like even if we account for the bond returns, there still seems to be some excess return. Well, this carry trade is a risky strategy. So I have to buy the long-term collateral. I'm either a more risky long-term collateral, like what the others call quasi-risky, or like a very safe German risky collateral. It's still risky. It's a long-term bond. There's some risk involved. So holding that long maturity bonds will give some returns. I always find when talking about repo, talking about safe assets in the collateral is kind of very confusing. The one safe asset to me in repo is always the loan, the repo loan itself, the short-term overnight loan. That's the safe asset. The collateral that is provided is usually always risky. It's like a safe asset, but it's a long-term asset that moves in prices around. So doing this carry strategy here involves buying a risky asset, but that's completely fine. I mean, that's part of it. So in that sense, I'm like confuses maybe too much. I just like would suggest or ask, why not do this accounting exercise that I'm doing? Just measure the carry factor directly, because independent of what I maybe misunderstand or I'm confused about, what is exciting here is this cross-sectional analysis of convenience yields. And even if I do my very simple look at this data, what the authors are able to do is really separate all the asset characteristics over the whole time series of how these convenience yields evolve. And this goes far beyond often. I mean, there's like this large growing literature on safe assets that I'm also try to work on. And often this is like kind of there's this catch-all term convenience yield or safety premium. And as I already said, like I find it's like for long-term assets, like what do we mean by safe assets and so on? What actually drives why certain bonds are more convenient than others. And here we can really think about a very detailed investigation of collateral characteristics. And I'm seeing Daryl here in the corner. So of course the author is discussing on the run versus off the run, which is part of the story, but is not the full story in the European bond market. For some reason, there's like this extra benefits here of holding even off the run German bonds often, and these characteristics change a little bit over time. So it's not always that German bonds are the most priced assets in the market and so on. So I think that's all very exciting and interesting. And so my suggestion would be to further, I mean, this is already very interesting, but expand further this analysis of convenience yield drivers. At the moment, I feel the time series component and the cross-sectional component is a bit separated. I'm not the most empirical person myself, but it seems like we really would want to employ the like panel study tools here, because we have this cross-section of convenience yield, but then we see them over time. And I think the repo is kind of more of a sideshow. It's not about, I wouldn't even call it carry, like a carry factor. This is not about repo. What the repo market here really allows to do is measure the convenience yields, not of repo, but of the bonds themselves. And I think this is a great setting to really back out this cross-section of convenience yields, and very exciting to read the paper. So thank you for the organizers for giving me a chance to think about the paper. That's all.
Thank you very much, Moritz. So we have 5 minutes for questions. If people in the audience, panelists or attendees have questions, feel free to raise your hand. There was one question from Giulio Nicoletti asking which tenors of repo transaction have been used to extract the principal component. Otherwise, Angelo, you can take a few minutes to also respond to Moritz. Angelo?
Yes, thank you, Moritz. Thank you very much for your discussion. I think what we try to do is to also capture the uncertainty on the realization of the convenience yield. So this is why indeed it's really important that it goes a little bit beyond the accounting exercise, because you have this uncertainty. And our purpose is to have an asset pricing model, very simple, but which indeed capture the two legs or the two sides of the repo contract. The cash, if you want, how to get cash pledging any possible eligible collateral, which is the market factor. And second, on the other end, the cross-sectional dispersion in the collateral's convenience yield. So that's our exercise. I think you nailed that in your summary. Indeed, we also run a panel, a regression analysis. So and with also fixed effect to control, for instance, and also we also take into account the quarter end, also possible seasonalities that previously Daryl stressed in the presentation before. The question about the other question was about the tenor. We use the overnight maturity. So overnight, spot next, tomorrow next, and the results are robust for the tree. I think.
When how you wanna go?
Yeah. So I think this echoes Maury's point. I mean the repo carry trade is really not the safe trade in some sense, because you have to swap the collateral between, let's say, German bonds and the Italian bonds. You actually have a buy one, short sell the other. I mean, is there a way to account for that risk when you calculate the portfolio returns? I feel that's probably critical for understanding the portfolio. And another thing is that, you know, in the asset pricing literature, people use portfolio, but there are just so many stocks. There's a lot of idiosyncratic movement. But in the repo market, we have very few different types of repos, even in the SC repo market, right? So maybe we can do the individual asset pricing and see how it works.
Good point. So the first one, we also have a section where we study the bond portfolio inclusion. And actually the performance is even better. So we take into account the fact that indeed the reverse repo implies that you need the collateral in advance. But we think that focusing on that setting, it's even better to isolate this collateral swap factor. And second, you're right, in US, maybe there is not so many different collateral assets. But in Europe, you have about 1,000. So if we are allowed to study the carry factor in the FX market with about 40, maybe 50 FX rates, I think we are even more.
Sorry, I'm talking about the government bond repo market.
Yes, the government, indeed, government bond, you have the Euro area countries. On top of that, you have federal agencies, supranational institutions, and maybe also privately issued collateral like the Pfandbrief in Germany and so on. So indeed, if you know the ecology of the market, you would realize that there are many different types. Thank you.
All right, we have 2 minutes left. Let's try to squeeze the two questions from Daryl and Sebastian.
Okay, thanks, Angelo. Great. In your previous work, you emphasized that many European government securities are on special in repo. And Imen earlier today said that the ECB and the Eurosystem generally lends securities, and that in principle should alleviate the need for government securities in the repo market and lower the specials. Have you looked at the common factors that determine these repos? I know you're focusing on I minus J, but there are also common factors like the supply of securities from the ECB, or the total amount of securities outstanding, or the amount held in certain hands that are likely to repo them versus those that are unlikely to repo them. Have you looked at those common factors and whether they help explain some of the variation in the data?
And then maybe you can take the second question from Sebastian.
Yeah, thanks. Just a very quick comment. I wanted a very interesting presentation. I like the heterogeneity that Angelo and his co-author are using in the European repo market. It's very insightful. I wanted to follow up on something that Moritz said, that sort of what is the safety of the repo, whether it's the actual contract or the collateral. And I think that maybe Angelo could say a little bit about that in his framework, given that, you know, you could have different tenors. So in my mind, the safety comes from the collateral itself. So I do a 1 week repo, I'll have that collateral for a week and I can use that during the week. Whereas if I say reuse it, then I won't have that convenience, if you will. So I was wondering if Angelo has thought a little bit about working a little bit with different tenors to kind of get at this issue. Thanks.
Yeah, so thank you very much. Both very good points. So indeed, we also sought to use the quantitative easing, in particular the PSPP program, as to capture some exogeneity in the collateral scarcity created by the central bank purchases program, and this is indeed would be priced in our setting, because the convenience yield increases with the scarcity of the asset, right? So we haven't really pushed that in this paper, but we found consistent results on that. So what Darrell was pointing out is very true. Although we haven't really studied who is holding these assets in this paper. So this could be another extension of this study, which would be very, very interesting, I think. Regarding Sebastian's question, that's a very good point. We haven't really studied the longer maturity, only because it's more illiquid, you know better than me. I mean, the 95% of the turnover is done with the overnight maturities that I mentioned before. There is some more in the 1 week maturity. Maybe we can exploit that. Yeah, it's a good point. Thank you very much, Sebastian.
Thank you, everyone. Let's not forget that we'll have breakout rooms after the next presentation where we can continue this discussion. Otherwise, Yiming, the floor is yours. So our next paper is Monetary Policy Transmission in Segmented Markets by Jens Eisenschmidt, Yiming Ma, and Anthony Lee Zhang.
Thank you so much. Thank you for the organizers for having us. It's really a great pleasure. This is joint work with Jens Eisenschmidt and Anthony. And Jens is with the ECB, so standard disclaimer applies. All right, and this paper is about monetary policy transmission in money markets, right? So money markets are important for that because it's the first stage of the transmission of monetary policy. And in money markets, repos or secured money markets have become the predominant form of short-term funding after the financial crisis. All right, and in Europe, there's been lots of work done, including the previous paper by Angelo. And lots of this work has looked at, specialness, whereby repos backed by collateral from different countries are trading at a different rate. All right, so here I have 4 different colors. The blue line are the repo rates backed by German collateral, and the yellow line, for example, is that by Italian collateral. Right, and the idea is that there's quite some difference in how these rates are how much these rates are over time, which suggests that different types of collateral are differentially scarce, right? And so just a minor point here about magnitude. So here we have about 10, 20 basis points of a dispersion across these different repo rates. And this is a big number for money markets, because in this time period, remember the ECB's monetary policy rate was only at negative 40 basis points, right? So lots of very interesting work done on this dimension. What we find is that there's not only dispersion across different types of collateral repos, right? There's also significant rate dispersion for repos backed by the same collateral, depending on which player you are in this market. Right, and that this dispersion in repo rates across different counterparties, this stems from dealer market power. So magnitude-wise, For example, in the French segment, we have a weighted standard deviation of 10.4 basis points, which recall what we just had for the collateral scarcity dispersion. That was also on the magnitude of 10, 20 basis points, right? So very, very significant difference in rates that different counterparties are obtaining. Right, and this coming into this data was very, interesting for me to discover, because I thought these are short-term, secured, not much credit risk really. This should be a very efficient market, and yet we see such a wide dispersion in repo rates. Right, and this is very important for monetary policy pass-through, because dealer market power that causes this rate dispersion is also going to impede the pass-through efficiency, meaning that if the central bank is changing its policy rates by, say, 10 basis points, then not all of that, or a much smaller proportion of that, is going to go in and affect repo market participants. Okay, and so why do we find what we find, right? So the existing literature, again, has mostly been focusing on collateral scarcity, creating a dispersion in repo rates. And the main source of data here is centrally cleared repos from e-trading platforms. Okay, and this is a very efficient, this is a great market, but the problem is that the majority of market participants, right? And these are not your mom and pop investors. These are institutional investors, including money market funds, mutual funds, pension funds, insurance companies. So very, very important non-banks in the economy. They do not have direct access to what we call the CCP markets, or these e-trading platforms. Okay, they rely on intermediated access through dealer banks that can participate in the CCP market. Okay, and so this over-the-counter market by these market participants is a very, very important segment of the market. So in volume in the euro area, the ECB's estimates is that it's 30%. In the US bilateral repos is estimated to be about 50% of the repo volume. But I would say that this probably is underrepresenting the economic importance, because if you think that some of the interdealer e-trading platform trades are just there to clear, right, the over-the-counter market trades, then this volume is underrepresenting the total, economic magnitudes of these trades. Right, so this is an important segment, but so far it's been unexplored because there has been no data on this over-the-counter market. And the ECB luckily recently started collecting data on this over-the-counter market, and it is this MMSR data set that allows us to jointly understand the over-the-counter and CCP repo markets. So with that data, we look at a number of stylized facts that point to the presence of dealer market power. We formulate dealer market power and collateral scarcity frictions in a simple framework that tells us then how these frictions go on to affect the transmission of monetary policy rates. Right? The model suggests that it is the collateral scarcity that affects how the policy rate passes through to the interdealer e-trading platform rates. Right? And then from there, it is the market power frictions, though, that affect how this interdealer rate transmits to everyone else in the market through the over-the-counter market. Okay, and the model we test using an actual rate cut, which is a September 2019 cut in the deposit facility rate from -40 to -50 basis points. And we confirm that the model predictions hold true, as in markets and counterparties that suffer worse rates before the rate cut actually experience a lower pass-through in the monetary policy rate they have, controlling for a number of different factors. Okay, and with the confirmed model, we can run a number of simple policy implications, including, if over-the-counter markets are the problem, if dealer market power is the friction, then why don't we just give everybody access to the e-trading platforms? And we find that the reduction in dealer market power through this exercise would be reducing the pass-through inefficiency, so that, for it's the same change in monetary policy, pass-through efficiency would be improved by 26 to 39%. depending on different collateral segments. Pass-through would also be more equal, meaning that different counterparties would be experiencing more similar or more equalized changes in their respective rates. And that reduction in dispersion would be from 8 to 26%, again, depending on the market segment. We also look at what the central bank can do, right? So if these platforms still have very restricted access, the central bank can actually step in and offer a secured deposit facility, similar to the RRP facility that the Fed has been offering for different market participants, including money market funds, right? So this will provide an outside option for everyone in the market that has access, in addition to what dealers can potentially provide. Right? And this can alleviate actually both collateral scarcity frictions, because this is a secured facility, and market power frictions by providing a viable outside option. Okay, so this is a very short summary, and we really stand on the shoulders of giants, many of whom are in the room today. But broadly, there's been lots of work on European repo markets that has focused on the value of collateral, the scarcity induced rates. And, we wanted to take a perspective that is coming more from monetary policy transmission and pass through to this market, where we show that even in such a short-term secured market, there are still sticky relationships, there's still bargaining power, market power, and that these things all come together to impede the transmission of monetary policy in a world where repo markets are now the predominant form of domestic money markets. Okay, so with that, let me tell you more about the details. So again, the data we use is the money market statistical reporting data set from the ECB. This is transaction level data on all trades in repo markets conducted by the main dealer banks in the European money market. It's the first type of data that actually contains also the over-the-counter market segment, which is very important for us to understand. And for each trade, we have the date, the collateral, specific to the ISIN level, the maturity haircut, the counterparty identity, location, et cetera, right? And we're gonna focus on the main segment of this market, including repos backed by German, French, Italian, and Spanish government collateral from February 2017 to February 2020. Okay, so the first thing we find is that customers or counterparties in general do not have access to the e-trading platforms, and in the over-the-counter market, their connections are very sparse. Right, the median over-the-counter customer only has one dealer that they are trading repos with, and even at the third quartile, there's only two dealer banks that the over-the-counter customer relies on, right? And in an extension exercise, we show, the standard results you would expect from this kind of very sparse connection is that having an additional dealer really helps, right? It's very costly, which is why not everyone has an additional dealer, but having one can help the customer to get better rates, right? So really suggestive of, bargaining, of sticky relationships in this market. And in terms of prices, we see results that are consistent with dealer market power. So first, dealers have a very high net interest margin, meaning that they borrow at lower rates than they lend in the repo market. Okay, so here's an example from the French market again. And here there's again 4 lines, but right now the red and blue lines is the interquartile range for dealer lend. And then the green and yellow lines are for the dealer borrow, right? So we see that, this red versus blue is higher than the yellow versus green, meaning that dealers are borrowing at a lower rate and lending out at a higher rate, making a net interest margin. Right, but notice that even within lend and borrow segments, there's substantial dispersion. Right, meaning that dealers can price discriminate depending on who they're borrowing from or whom they're lending to. Right, so this is again suggestive of dealer market power. But here you may wonder, well, you're looking at the French segment, or in the paper we're looking at the German and the Spanish and the Italian segment, but there could be very different types of collateral, especially in special collateral repos. So we agree which is why we then went on to purge the repo rates we observe of these specific ISIN level collateral characteristics and other loan characteristics, right? We residualize the rates, and then we recompute the net interest margins and the rate dispersions, and we find that a significant portion of both of them remain. Right? So for each of these markets, German, Spanish, French, and Italian, we have net interest margins on the left, weighted standard deviations on the right. The dark bars represent the raw data that we computed. And then after residualizing the rates against these loan characteristics, we are left with the lighter bar, which shows a lower net interest margin and a lower weighted standard deviation. But, remember, 10 basis points, even 7 basis points. These are very, very substantial magnitudes for money markets, right? So this shows that, it's unlikely that specialness explains what we see. It's much more the case that for the same trade, everyone is getting a different rate because dealer have market power and dealer can price discriminate. Okay, but let's formalize this conceptually. So in a model, very, very simply, we have a central bank that sets an unsecured rate roll. Interdealers have access to this rate, but they like collateral, so they are trading in the interdealer market, or think about the e-trading platform at an interdealer rate RID. Now, customers do not have access to the interdealer market. They rely on intermediated access and bargain over the repo rates with the dealers. So a depositor, right, a over-the-counter depositor would get a rate RD that is lower than the platform rate, again, because the dealer has that market power. Okay, so the level of rates depends on dealer market power. Right? But it is also monetary policy pass-through that is impeded by market power and collateral scarcity. Specifically, we can show that the role, the monetary policy rate, that pass-through to the customer's deposit rate is first impeded by collateral scarcity that affects how the monetary policy rates feed into the interdealer rates. And then how the interdealer rates feed into the over-the-counter rates, that is determined by how much bargaining power the counterparty versus the dealer have. Okay, so with that in mind, we have a number of predictions. And again, the model has details. This is just a sketch. The first one is that if there's a market in which there's higher rate dispersion before any rate change happens, then that is a market in which dealers have higher market power, in which they can better price discriminate, and that market has a lower monetary policy pass-through. Now, at the customer level, if a customer gets worse rates, in general, then they also experience a worse pass-through from their dealers after a change in monetary policy rates. Okay, now let's see if this holds true in the September 2019 deposit facility rate cut from -40 to -50 basis points. Okay, so we use the observed changes from this rate cut, and in particular, we measure pass-through just by dividing the change in the repo rate pre and post for a given collateral. Okay, and we divide it by the -10 basis points, which is the change in the monetary policy rate, and this would be the pass-through in percentage of the monetary policy to the over-the-counter rate. Okay, similarly, we can do that for the CCP, or the interdealer e-trading platform, to the over-the-counter market pass-through. And here we are just looking at the pass-through for the same collateral of the changes in rates in the over-the-counter versus in the CCP market. Okay, so we look at these in the data, and first we see a lot of evidence consistent with our first prediction, which is that in markets where the rate dispersion was higher, and here we're looking, for example, at the interquartile range. See, here we have a higher interquartile range. The pass-through in those markets is going to be lower. Okay, so worse rates indicating, or more dispersion indicating more dealer market power, consistent with a lower pass-through after a rate cut has happened. Okay, this holds true in a regression form for different countries as well. We have a slight statistical significance issue in the Spanish market, where we do not have many observations for. But in general, this is a very consistent observation. Okay, now this also holds true if you look at individual customers, right? Whereby if our dealers are borrowing, or if, in other words, the customer is depositing with the dealer, then a higher deposit rate means that the customer has a better bargaining power, right? That feeds into a higher pass-through after the monetary policy rate has changed. Okay, now this is negative on the lend side because there it is a lower rate, right? That is indicating a better customer bargaining power. Okay, we can do this with residualized rates, again, purging the effect of individual collateral ISINs, and OR main results survive, right? And these tests that we have of the model, can, remove some other potential confounding issues that you may be worried about. If you just look at the level of net interest margins, for example, you may be worried about dealer balance sheet costs creating some of that, right? But if you look at the pass-through, then all those static frictions should not be affecting pass-through, because pass-through, as our model shows, is really the result of dealers being able to control how much of their rates is passed on to customers. Right, and that's why we think of this test really as a better way to show the presence of dealer market power. All right, so with that, let me show you quickly what we get in the policy counterfactuals. The first one is, let's just give everyone access to the dealer platforms. And if that happens, then we no longer have dealer market power. Right, so in the data, we look at, for the same collateral ISIN, what's the rate in the over-the-counter market, and we look at the corresponding rate in the CCP market, and we assume that just the over-the-counter rate is the CCP rate, and we recompute what pass-through would have been, both in terms of the average as well as in the standard deviation. And what we find is that for different countries, for different lend and borrow segments, pass-through would be higher. Right, so the 10 basis points will feed up to a higher change in rates for the general market, and the improvement will be from 26 to 39%. At the same time, because all the counterparties are getting the same change now, the dispersion in pass-through is also reduced, and this is also significant at between 8 to 26%. Okay, now this may not be feasible, if the e-trading platforms do not want to allow access, as is currently the situation. So one other thing the central bank can do is to directly offer a secured facility to different market participants, right? So this would be similar to the Federal Reserve's RRP facility. And this helps because the secured nature of this facility would provide a floor on repo rates, alleviating collateral scarcity frictions. But this would also help by alleviating dealer market power, because it's an outside option for all the participants to use, and to say to their dealers, hey, you cannot rip me off anymore, because now I can get this outside option, this feasible, incredible outside option from the central bank. And this is important because even if there's no actual uptake, right, even if the central bank balance sheet is not expanding, this could be an effective outside option to improve pass-through efficiency in the repo market, just by having the option there for the counterparties to use in their bargaining. Okay, so with that, let me quickly wrap up. Again, we find significant market power frictions in a market that is short-term, that is secure, that traditionally we think should be very free of frictions and credit risk. And that is important because it impedes the transmission of monetary policy. We have a simple model that shows how the dealer market power can arise in the repo market, and how it affects the monetary policy transmission. And we test the model, and we use the model to show some simple policy counterfactuals, including providing CCP access and including providing an RRP facility. With that, thank you very much. And I look forward to in-house discussion and everyone's comments. Thank you.
Thank you very much, Yimin. Wenhao, the floor is yours.
Can you see the screen?
Yes.
Yeah, okay. Hello, everyone. It's really a great pleasure to discuss this paper. And Yimin has elaborated on the content. Let me just give you a quick recap. So this paper basically shows that banks and dealer banks have market power, and by using the European OTC repo market data. Now, by saying market power, I mean, it's more specifically referring to the bargaining power of dealers when they make transactions with the clients in the OTC market. And this market power affects monetary policy transmissions. I view this paper of having 3 contributions. The first one is to show some new facts about the OTC repo market that really suggest the existence of dealer market power. And the second one is to build a stylized model that has 2 testable implications that the authors go to the data and confirm with the money market data that actually has a transaction level of details. The 2 main predictions, the first one is higher rate dispersion in the OTC repo market implies a larger dealer market power, which means lower money policy transmission. The second one is for the OTC customers that receive worse rates from the dealers. The repo rate would be less sensitive to money policy because, again, more dealer market power. And finally, the paper offers some very interesting counterfactual analysis, like introducing a reverse repo facility in Europe. Now, to give you a high-level overview of the European repo market, so here, I borrowed this figure from Darrell's paper on redesigning treasury market. They share a lot of common features. So in the European repo market, it has this core peripheral network structure. The dealers have access to the centralized counterparty that is trade in the centralized market. So for each repo type, there would be a market clearing price, which is common for all the dealers. And then for the clients, they have to trade with the dealers. As Yiming already showed, these clients have very sparse connections with dealers. The median connection is only 1 dealer, sometimes 2. Now, this is suggestive of market power. And then this market has 2 types of repos. One is GC, or general collateral repo, where the whole pool of collateral are treated exactly the same, and they would obtain the same rate regardless. And this market is mainly for the financing, for example, the dealer financing from the money market funds. And the other market is SC, or specific collateral repo market. And here, the different securities are really treated differently. For example, 5-year German bonds would be treated differently from the 1-year, and they would obtain different rates. And in this market, the main purpose is for the underlying security. For example, imagine you're a hedge fund, you want to short the 5-year German bonds, you would lend in the repo, obtain the security, and sell it, and then continue rolling over the position until you want to rewind your shorting position, right? Now, this paper chooses to focus on the SC segment, although actually they have the data on both segments. And the reason is that in the SC market, the turnover is much higher, as you can see from the figure. All right, so the turnover volume is about 5 times in the GC market. But I would say, this also suggests, GC market could be of lower liquidity and which could have more room for dealer market power, OTC segment of the GC market. So that's something worth investigation. And the paper provides some new facts about this OTC repo market that is suggestive to dealer market power. For example, the median repo customer, as I mentioned, has only 1 trade, so it trades only 1 dealer. Right? A dealer also obtain a significant interest margin on the OTC market. But of course, these are not definitive because there are alternative explanations. For example, as long as you have an outside option, then that could engage the dealers into a competitive behavior. And the bank's balance sheet cost might cause this lending rate to be above the borrowing rate. And to address this, to further provide evidence on market power, they developed a simple model that generates more of the unique predictions on market power and monetary policy transmission. Before turning to that, I want to discuss what kind of market power should we focus on. I think there are 2 forms of market power in general. So this paper is focused on this more of a bargaining power. So the dealer and the client would bargain for each trade. Now, the key feature of this power is that both dealers and clients are determinants of the markups above the CCP rate. For the clients with fewer connections, they would have less bargaining power. So actually, I would expect the client side to explain more of the variations because we have very different clients and with different access and sophistication. Right? The other form of market power is more of the common type, we think, in Econ 101, where the dealers could charge the same rate for the specific repo type for all the clients, right? But they account for the aggregated demand effect. So they act strategically. And the key feature here is that only the dealer determines the markup, right? So I'm very curious in the data, which one is more of the case, because it's very important for how to model this OTC repo market. And after accounting for the loan characteristics, what is the relative exponential power of the dealer versus client fixed effect? Now let's take the model in this paper, which is the bargaining model. There's one key equation that embeds the key intuitions. Suppose there's a Nash bargain between dealer I and client J for a given security K. Okay, the repo rate is a weighted average of the CCP rate, where the dealers have access to, and also the client reservation value of the repo. And then it's the weight is related to dealer's market power. If the dealer's market power is stronger, then it's closer to the client's reservation value. Now the prediction from this is that conditional on larger dealer market power, as you can see, there's a higher multiplier before the client valuation. So we would expect a higher cross-sectional dispersion of this repo rate. And also because larger market power, the sensitivity of the repo rate on the CCP rate would be lower, where the CCP rate is closely controlled by the deposit facility rate. Okay. Now, mapping to the empirics, the current approach is to measure the dispersion of the repo rate at each security level. But I would say here what we care about is that when we measure the dispersion of the repo rates, we would like to keep the dealer's market power relatively constant. Now, it could be a better approach to measure and to cluster the dispersion at dealer or client level, right? And the related comment is that why we're restricting the analysis in the SC market. So I don't know here, maybe the authors could clarify. Suppose we have a large OTC segment in the GC market, and then actually that's better for the analysis because we don't have to worry about collateral scarcity of a specific collateral, right? Then a more general comment about market power and the money policy. The first one, it's really has two aspects. So first one is how do we extract market power in asset prices? I think this is a very, very challenging exercise because there are a lot of confounding factors, like the risk premium. Different securities have different risk premium, even for the same asset. Different institutions might charge different risk premium. So I think we can add country fixed effects throughout the specifications to fully address this part. And the second one is the balance sheet cost. So different banks, they have different balance sheet costs. So whenever we can, I think the regression specifications should add bank fixed effects. And finally, I want to use my final 2 or 3 minutes to talk about monetary policy transformation. So there is a long history of the literature that studies monetary policy transformation. I mean, key distinguish here is the anticipation effect from market participants versus the actual shocks during the policy announcement. And furthermore, the term structure of the asset is very important in the sensitivity, which potentially confounds with the findings. So let me show you that the anticipation effect. So here I collected data from the German repo market and also Italian repo market. So here I plot the rates around the September 2019, which is the event studied in this paper. Actually, that's the only event from 2017 to 2020 on the policy rate cuts. You can see that the 1 week GC repo already kind of declines a week ahead of the announcement. And 1 month GC repo declined a month ahead of the announcement. So there's a lot of movement already way ahead of the actual announcement. So therefore, there would be an attenuation when we actually measure around the announcement dates. I think potentially a potential exercise authors can do is to use the Euribor interest rate futures to extract the surprise component, just like the typical Kuttner shocks in the Fed funds rate surprises. And this has additional advantage because it could give you more events to study. Because although around the 3 years of the window that we have, the authors have data with, there's only one policy cut. There are a lot of ECB council meetings. Even though there is no policy change, ex ante, the participant could expect there would be a change. So actually no change could be a surprise. So by doing it in this way, there could be more shocks or more events to study, which enhances the statistical power of an analysis. And final point on maturity. So, ex ante, I thought, all the repos in the European repo market are probably very short term, like overnight or week, but there's a lot of actually rate dispersion. So here is the data from a repo market survey. Actually, you can see that, from 1 day to 12 months, there's a wide variety of maturities. Now, it actually matters a lot. So here I'm using the data from the US market to show you that maturities kind of affects the monetary policy transmission a lot. So here I measure the Fed funds rate surprises following the Kuttner approach from the Fed funds future. Then I measure the 7-day change in the repo rates in the US market. And you can see that from 1 week to 12 months, the sensitivity kind of monotonically declines by a lot. So at the 12 months, the sensitivity is only half. Right? So it's very important to control the maturity of the underlying assets throughout all the sophistication. So let me summarize. So I think this is a great paper with new facts and evidence on dealer market power and monetary policy transmission in the European repo market. And I have some suggestions on the potential improvement on first exploring the type of the market power before arriving at the specific model. And the second is adding the fixed effects to address the dealer balance sheet cost and also maturity controls. And finally, to use money policy surprises to potentially get more events to analyze. That's it. Thank you.
Thank you very much. Yiming, we can start by taking the 2 questions from Daryl and Angelo, and then if we have some time left, you could answer to Wenhao to discussions, comments.
Yiming, thanks. I learned a lot. Great paper. So I'm wondering whether there's some way to get at Wenhao's question of where the bargaining power is coming from by looking at customers that are lending versus borrowing. So, and for rate hikes versus rate drops. And I realize that rates have mainly been just dropping, but from deposit rate data, the research shows that when central banks lower their deposit rate, monetary policy transmission doesn't work that well because banks will quickly lower the deposit rates that they offer. But when the central bank raises its target rate, banks are very slow to raise the interest rates that they offer to their customers. And you get this big asymmetry that stems not from a kind of Nash bargaining power, but more from taking advantage of a lack of sophistication of the customers. And if you maybe can separate the borrowing versus lending customers and the rate hikes from the rate drops, you might find that some of what you're measuring as a kind of Nash bargaining power coefficient is actually more related to the sophistication associated with knowing what your best outside option is, which is a different part of the Nash bargaining problem.
Yeah, I think it's my turn, right, Adrian?
Yes.
Yeah, following up Daryl's suggestion, was wondering if the tiering, the inception of the tiering system could also be a monetary policy event that you might try to exploit, right? If I'm in a cross-section of banks, now I have more central bank services available or not. Does it impact my bargaining power or willing to exercise my willing power. That's one. The other point that I was wondering, and curiosity actually, right? In the interbank market, being CCP based, you have more, netting benefits in the collateral, right? Instead, in the OTC, you don't have these benefits. How do you deal with that?
And then we can probably take a last question from Quentin, and then we can answer to everyone.
Yeah, actually, I have one comment and one question. Can you hear me now? Yeah, okay, I wasn't sure. Yeah, so the comment is that, so you're talking about lower pass-through, but what actually happens that when you had the rate cut, the pass-through was actually improved in a sense by the fact that these dealers have higher market power because the rates went even lower. So I think that's kind of interesting. Maybe that's something that the central bank would be happy having or keeping for that time. And so the question is also related to Daryl's points, and that's also something I asked a related question earlier when I was the paper earlier. I think there is this very interesting trend in one of the graphs that you've shown, that the spread seems to be contracting through time. I think it's for the French repo in particular. So I'm wondering if there isn't like an interesting dynamic effect, which might be related to what Daryl just mentioned.
All right, I think that's all the questions. So thank you so much, Wenhao and Daryl, Angelo, and Quentin. Those are really great comments. Let me try to cover what I remember, and if I don't, maybe we can talk more after. First of all, so GCSC. So I agree, it's important, and actually maybe we didn't make this very clear in the paper, but we do have GC in the sample, and what we do for the residualization, for example, is we control for the GC as an independent ISIN. So we assume it's like one pool, one collateral label, and that is how we deal with it. We also control for the maturity of the trades in the residualization, so none of the results should be driven by maturity differences. Now, I agree that maturity is particularly important for the anticipation effect, because if you have a longer maturity trade, then you expect something to happen in the future, then that is going to be incorporated into longer maturity loans. And so the current test is on the full sample, but as also Angelo mentioned in the earlier paper, the majority of the turnover is really in the overnight, the next day segments. So our results would still hold if we were to do everything on the very short horizon, for which the anticipation effects really wouldn't be that important, because the trade is going to expire. And on the empirics, Daryl mentions, yes, so unfortunately we do not have a rate hike, so that we can't really contrast any asymmetry in the results. But even for just the rate drop, what we do see is that dealers seem to exhibit more what we call bargaining power or market power in their borrowing trades, or in the customer deposit rates, right? And this would be consistent with the story in which they're more reluctant, they're more willing to drop the rates when the central bank is dropping the rates. It's also, though, consistent with a reserve-rich environment in which everyone is just looking for a safe place to park their cash, and that dealers can get more bargaining power out of people who are looking for a safe place to park. So we look forward if the ECB is going to raise the rates one day, and we can observe that. But currently, we do see consistent evidence with some of it using just the dispersion that we see for the deposit relative to the borrowing of the dealers. And then, yes, so thank you, Angelo. Yes, we haven't looked at tiering. We haven't matched the reserve data, actually, but it would be definitely interesting to explore, especially given how new this policy is. In terms of netting, I think that is very important, especially for thinking about balance sheet costs of the dealers, which is definitely going to be driving part of the net interest margins. But again, as we show and in the paper, we think net interest margins are likely affected by say netting or balance sheet differences. But if you think of dispersion across different counterparties, right? And unless the netting is very different across different counterparties trades, then otherwise it's unlikely to cause the dispersion. It's also unlikely to be changing differentially across different customers as the monetary policy rates are changing, right? So that's why the monetary policy test is really something that we are hoping to use to tease out the effect of bargaining power from other important dimensions such as netting. Quentin also had a very important observation, which is that, over time, the dispersion between, say, German rates and Italian repo rates are decreasing over time. And this is not the focus of our paper, but it's an interesting observation. And after talking to some market participants, we think it's not as much the ECB security lending facility, because the rates of that facility are actually not as attractive because they're based on market rates. It's more other types of market participants, such as hedge funds, actually coming in and trying to get a share of some of these trades. So that is why the spreads are declining, because there's market entry over time, especially in the German and French segments, where there is just a bigger pie to share, basically. And that, let me end with the theory. So this is important for us to understand. Whether we're thinking about a bargaining world in which connections matter, and this is about sticky relationships, or whether this is IO 101, where you have a demand curve and the monopolist is setting the price. We really think of this as bargaining, right? This is not a cereal market that everyone can walk into the supermarket and buy a cereal and the cereal producer is setting a price. No, these are bilateral relationships that customers form with dealers that require over the time due diligence, that require a relationship, and then where they then go and negotiate the prices. And empirically we can see the evidence for it, because different counterparties are getting a different price, right? In contrast to everyone is paying the same price for cereal. We can also see that you're paying a better price if you have more dealers, right? That means that you are actively trading off and bargaining with different dealers at the same time. It also shows that different sectors have access to different rates, likely because they have different outside options that they have available from the wider economy. And so I think that this is important to understand, I think, for different over-the-counter markets, not just the repo markets, because it's then the bilateral relationships that determine how much monetary policy can pass through. So with that, thank you very much.
Fantastic. So thank you, everyone. That was a great first day. So now we're going to open breakout rooms. So everyone, both panelists and attendees, are welcome to join us to continue the conversation on the Zoom link. So if you click on the Zoom link, you will have access to 4 breakout rooms, one for Darrell, one for Imen, one for Angelo, and one for Yumi. And we can continue to chat right there. Otherwise, thank you everyone for attending this Thursday, and I hope that we can continue to chat until in this breakout room. Thank you. Angelo, did you receive the link?
Hi, sorry.
Yeah, so there is a breakout room that is set up for you if people want to talk with you about